Namaste, investors. This is Dhruv Bajaj from SmartSync Services. We recently hosted a very interesting investor called Sajal Kapoor ji, who goes by the Twitter handle Unseen Value. And उन्होंने recently एक बहुत interesting investing book भी लिखी है by the name Framing Business Uncertainties. So in this session, he talked about fragile and anti-fragile business models and कैसे आप नए नए stock ideas discover कर सकते हो, both in pharma as well as non-pharma space. So without any further ado, let's start the session.
Hello everyone, I am Ankit Kandia, founder of SmartSync Investment Advisory Services. We are SEBI registered investment advisory firm based out of Ahmedabad. Welcome to the 18th episode of Mission Smile Investing Karwa. For those who have joined us for the first time, Mission Smile stands for making new stock market investors learn it through engaging research. And on the 18th Investing Karwa episode, we have a special guest, Mr. Sajal Kapoor. Mr. Sajal is a very seasoned investor and a popular personality on Twitter. Close to 1.5 lakh people follow him there. He has recently written a very good book titled Framing Business Uncertainty. I have recently finished reading it and thoroughly enjoyed it. I have a few questions from the book as well. And as a responsible investment advisory firm, we would like to share the disclosure upfront that we may discuss a few businesses as case studies in today's session. Some of them we might be owning in our portfolio. However, do not take it as a recommendation. And as promised on Twitter, this session is probably going to be the most interactive session we have ever had on Mission Smile. And those who are joining live, you will get two big early mover advantage. Number one, the recording of this event will be put up only after 2 weeks. And number two, a 20% discount on Mission Smile, 1 year access only for members or investors who have joined us live. We'll close this exclusive offer immediately after the event. Harshal from my team will be sharing all the details on the chat box. I'll now start with introducing Mr. Sajal Kapoor. Sajal is a random investor who magically avoided the top of the Harshad Mehta bull run in 1992 by making an entry 12 months after the meltdown. He invested randomly in almost every IPO that was singing and dancing in the mid-90s and randomly doubled money in just 2 or 3 IPOs out of some 100 odd IPOs subscribed. He luckily sold Global Trust Bank, HDFC Bank after they doubled. Balaji Amine was the other one that he sold very early, as he was fooled by randomness and tremendous anxiety as most IPOs collapsed or disappeared a few years after listing. The role of luck and randomness has been prominent in his life. As a risk and compliance professional, Mr. Sajal frequently engages with CXOs in the global life science industry to discuss emerging trends and strategic growth options. He has presented anticipated developments and insights at several conclaves. He has assisted global investors by connecting the dots between business uncertainty, optionality, transience, pivoting, and antifragile perspectives for screening possibilities in the face of perceived uncertainty and the key pillars of investment wisdom acquired over 30 years. With this, I would invite Mr. Sajal to please kickstart the event with an opening remark and then straight away to his presentation. Over to you, Sajal.
Thank you for the kind introduction, Ankit. Really appreciate it, and I'm very happy and pleased to be here. So thanks for having me. And I think we can start now. So first up, there will be lots of stock discussions. None of it is a recommendation. So please read the disclaimer. It's there right in front of you, and I will be repeating this disclaimer every now and then as I progress through this presentation. My expectation is that I want to make this an interactive presentation. So rather than taking all your questions in the end, Let's have it much more interactive and engaging session. So as I progress, if you have got questions that are relevant to the topic, uh, and if possible on that slide itself, please put them in the chat box, and then we will be taking them quite happily. With that, I think the agenda is not a long one. I think the case studies will take most of the time. So we have got about 6 case studies that I have created. And I think we will be playing a little game where once I'm through with the section on assessing the fragility, Ankit will kindly share a random name, and we will together look at how we assess the fragility of that business. And I hope that will make it much more fun filled and could be a good learning. And your questions will also help me learn as well. So starting with the introduction, fundamentally, there are 3 types of assets, individuals, industries, so on and so forth. So one is the fragile, the other one is robust, and the third category is anti-fragile. Of course, all this I have gleaned over the years from Inserto series created by none other than the philosopher, Professor Dr. Nassim Nicholas Taleb. So first up, fragile hates disorders and is harmed by the friends and family of uncertainty. The friends and family of uncertainty are things like volatility, lumpiness, unknown, unknowable, chaos, disorder, disruption, those kind of things that you could think of. Time also is a very prime and important member of the disorder family, if you like. Fragile will suffer from volatility and disorders, and more downside than upside. So as an example, I mean, this is a fragile mug, right? And if I drop it on a hard surface from about a meter or so, it will break. And that is the nature of any fragile business or any fragile entity. Under a certain stress, the moment the stress is breached on the lower side, it will crumble. Ultimately, all fragile things, they collapse. It's just a matter of time. And mug is one example of fragile. We have seen many businesses that were deemed robust or anti-fragile when they were all guns blazing, and they just collapsed. Right? So fragility is something that we could assess, and I've created a framework which I actively practice and use, and that can be used to assess the fragility of management, fragility of a business, and the fragility of overall industry structure. The next one is the robust. And so robust recovers quickly post the volatility and the disorder. And I would like to clarify one thing here, that when we talk about volatility, we are not talking about a very large magnitude of volatility. Everything is good to an extent, right? So COVID created volatility, which was kind of towards the extreme end, but the volatility was short-lived, few months, right? And then as soon as the volatility reversed, we found out that all the robust businesses, they went back up. So from Pidilite to consumer businesses, all the essential consumption, including healthcare, they recovered pretty quickly. The important characteristic of a robust business is it remains unchanged because it's resilient. It will swing under volatility, but as soon as the volatility is away and it's gone, it will resume, but it will not gain after that volatility ends. And that's where it's kind of slightly it's slightly different from anti-fragile, because anti-fragile business will also suffer from small stressors and disorders. But then they need a period of recovery to sort of learn from those mistakes. So disorder is kind of giving them a feedback, a stressor is giving them a feedback. And they want that feedback because and then they can learn from that feedback and pivot or change course and make a new high in their performance. That's the inherent characteristic of anti-fragile businesses. That's also an inherent characteristic of any anti-fragile management. They will make small errors, they will make small mistakes, but they will quickly learn from those mistakes and they will improve. So it's good to make small mistakes for someone who is prepared to learn the lesson. It's not good to make small mistakes or big mistakes for someone who is rejecting the feedback and they're not prepared to take that feedback into their strides, change course if depending upon what sort of feedback is that, and then make a new high in their performance. Fragility, anti-fragility, it's kind of a continuum. It's dynamic, and inertia plays a very big role. So Newton's first law, right? If a body is in a state of rest, it needs a trigger, it needs something, otherwise it will remain in the state of rest. And likewise, a body that is moving will also continue to move unless there is some sort of a friction, right, to stop it. And that's exactly what this fragility and anti-fragility is all about. So a fragile management will stay fragile, or a fragile business will stay fragile, and it needs some sort of a trigger to transition from fragility to anti-fragility, and vice versa. So I've seen enough businesses that were anti-fragile ones, and we have a case study on Wockhardt. Wockhardt was a beautiful business, extremely anti-fragile management. When Mr. Senior Khorakiwala was not that senior, he was young, energetic, passionate. So I'm talking about 90s here. And it was a great business, but then over a period of time, things happened. There was a collapse on their balance sheet because they were playing in the F&O derivatives space. And that shock, as they were recovering from that shock, they had multiple shocks, one after the other. And the important characteristic is followed by a period of recovery. In case of Wockhardt, because the shock was extreme, so regulatory non-compliance, they couldn't recover from that shock. And so it started with Valuj, I remember. So I was an investor in Wockhardt. Started with Valuj, and then it went on to Chikalthana, and then I think Shendra was one of their new plants. They promised and they were confident that they would be able to do tech transfer from Chikalthana or Valuj to Shendra, because a new plant, US FDA will hopefully not have any. But even there, US FDA found serious issues. So all their US FDA approved plants. So Shendra wasn't approved; it was a new one, but that couldn't secure the US FDA approval. And the story didn't end there. US FDA also stopped them from supplying one of their US plants, which was the Morton Grove, the facility they acquired. So one after the other, these shocks and the hit on the cash flow. So first it was the balance sheet hole that their finance team committed a blunder. 1,800 was a big amount for any business, and Wockhardt was only a mid cap. So they had to liquidate all the good businesses, because when you are under stress, under a lot of debt, you start deleveraging and you find a market for whatever you could sell. And they could only find market for their good branded business in India, or the branded OTC, so Proteinex, Farex, all great marquee brands. Exceptional demand pull from consumers. They had to liquidate all of them, because those were the only assets they had where they found the buyer. And since then, we've seen Wockhardt has been kind of in some sort of a doldrums. Operating cash flows are nowhere. So what was a very strong anti-fragile business led by a very strong anti-fragile management team is now being managed by someone who is 80 years plus, with no sort of succession planning, and he is still so Mr. Senior Khorakiwala is still the front end of that business, right? I mean, when someone is 80 plus, you expect that they will enjoy life, they will travel the world, and they will have all the goodness which they deserve, actually, because they have been um, invested with all their skin and soul in the business for decades. But in this case, there is no professional management, and second generation is not good enough. So unfortunately, Mr. Habil Khorakiwala had to be the only sort of leader of front end in the organization. So there are clear signs of fragility there. And again, I've been talking about the life sciences sector, but I would have to I must clarify that fragility is sector agnostic. It's completely sector agnostic, and that's the reason I've created the case studies across sectors, from infrastructure to consumers to healthcare to innovators. So I've got examples of Roche and others as well, to give you a holistic view of how this whole continuum of fragility, robust and anti-fragility actually behaves. And I'll let you read this, and I'll explain what this is all about very quickly. So there was a German toxicologist, a guy called Hugo Schulz, right? And he accidentally, most discoveries in this business, in the business of innovation, happens by chance, pure serendipity. So he was looking for something, but he discovered something else, and he found out that the effect of toxins in small doses is actually beneficial, which is exactly what the characteristic of anti-fragility is, that when you give stress in a small magnitude, and not a chronic stress. So you give a small amount of toxin, very small measured, and then you give them time to recover, and then you repeat the whole process again and again. And that will ultimately be beneficial. So that's what I've quoted, and I've mentioned the source as well. It's all available online on Google. You can validate this later on. Next thing is, sometimes it's difficult to figure out what is a good business, but it's relatively easy to figure out what is not a good business. So in a negative way. So if I see something, I know that this is not God. If I'm looking for God, right, it's very easy for me. Rather than describing what God is, it's easier for me to describe that this is not God in that sense. And the fragile business will do all it can to sort of hide the defects, the bad aspects of it, and display the qualities. And so what you would find is that the fragile business will show you profits after profits, small profits, but then, because the business is fragile like this mug, ultimately it's just a matter of time. It will collapse one day, and when it collapses, it will take out all the accumulated profits over the period of several years, and that would be the game over. So how do we win? We win by not losing. And in the context of whether it's management planning a capex, or an investor planning the next investment, we ought to know the floor. What's the downside? What's the max I could lose? And not worry too much about the ceiling. What's the upside? Because typically people think about whether it's a 10 bagger or a 100 bagger, which I think is the wrong approach. You should be worried about what's your downside, where is the floor, and how low is the floor. What if you fall from where you are onto the floor? Will you survive? Because survival is paramount. You have to survive in order to thrive ultimately, right? So that's what this is all about. And it's in the mindset. Anti-fragile mindset would keep it simple. And as Steve Jobs said, beautiful line there, innovation is saying no to 1,000 things. You have to say, no, I don't want this. No, I don't want this, because you have to stick inside your circle of competence as far as possible, because your ability to measure fragility, your ability to value an optionality, um, along with a good margin of safety, probabilistically speaking, improves when you are operating inside your circle of competence. So that's what Steve Jobs was highlighting there. Invisible gorilla. I mean, I'm sure most of you must have kind of seen this. So it's a very famous case study. If you just Google invisible gorilla, it's a very short video as well. So the whole idea is, and I'll cut the chase here. Whole idea is to the message is to focus on the big picture. Try and separate the noise versus data, and also not just stay blinkered with the headline data, because that's what the media and the market will continuously throw at you. The headline numbers, EPS, what's visible. Try and go one level, two levels below, scratch the surface, and try and dig out the real data, because the real data will give you the real feedback about the earnings power. And best investments are those where you buy deep value and then the growth starts unfolding. Those are the beautiful setups. Those are the beautiful businesses. So you're not paying for that growth. You're buying something at very deep value, whether it's price to book or price to sales or enterprise value, whatever, EV, EBITDA, whatever you use, other than PE and even EV, EBITDA to an extent. And I've explained this in the book. I mean, I'm not a big fan of either of them, but I use a variety of them just to figure out, because if you're using PE, there is nothing wrong in it. You have to normalize it. And so not just look at the headline that, PE is X doesn't mean anything. PEX doesn't mean anything. You have to normalize why it is high if it's high, and why it is low if it's low. So you have to ask too many why questions, and almost counter confirmatory. So soft signal should always be out. And then you find the evidence that why your decision was wrong, i.e. the out decision, and you need to declare this batsman not out. That's the kind of mindset. If you can adopt that, it's difficult. It took me ages to get there. So I mean, as Ankit kindly introduced, I mean, I started my journey losing everything. Money was a very scarce resource for me, because when I was very young, I lost my parents, both of them. So I was staying with my Naniji and Nanaji, maternal grandma and grandmother, and they were retired. So money was always in short supply. And I had one of my uncles, so this was in Lucknow, one of my uncles was working in a bank. So I used to, because in those days there were no ATMs, right? I mean, they used to carry a paper passbook, and then there will be money in, money out entry. And if you need to withdraw cash, there is no ATM, you have to go to the bank. So, and he was the head of that bank. So I used to visit and go straight into his chamber, enjoy, a cup of tea, sometimes two or three. And in one of those days, it must have been 92 period, before that Harshad Mehta bull run, right? And he and he and some of his friends, so there were 3, 4 people already sitting in his cabin. They were talking about something called shares. And I had absolutely no idea. That was the first time, because there was no culture of investing in my right, retired people, I mean, as you might imagine. So they were talking about shares, and they were very happy. So I could smell that there is an opportunity, speculative mind, young person. Um, so then he explained that there is a big what is called bull market. What is bull market? Oh, you buy today and the stock is up tomorrow. That's what the bull market is. And I said, well, that's very easy. And so I said, if the price is X today, I mean, oh, tomorrow it will be up. I mean, so they were discussing many stocks, including SEC. I'm not sure whether he was invested in SEC or not. So that's when I started. And you should read Economic Times, and you should read some business magazines um, and all the rest of it. So I started reading Economic Times from the same day. So this was Lucknow. The Economic Times used to come in the evening, 4 o'clock, 5 o'clock, or something. And sometimes it will not come. And my vendor used to only order 2 or 3, because there was hardly anyone in it. There was no equity cult. I mean, I'm talking about 92, 93 era, right? There was no equity cult. No one was interested in stocks. So and then that's how I started. And because I was so speculative and I always wanted more money, when I got through engineering, so this was in Lucknow University Institute of Engineering, and in those days it was under Lucknow University, and I think the setup has changed now. So because of my family history and background, there was a scholarship scheme. Scholarship means money, right? And the only condition was that I must score 75% consistently and not fail. Uh, and I thought that's doable, and I get money. So I started precision control my studies, so that I must secure 75% every semester, and I'll get this cash, and I'll invest this. So uh, luckily, luckily for me, the IPO boom was going on. This was mid 90s, so still remember SR Oil IPO, a lot of IPOs, Sri Shakti LPG, Prasari Cellulose, Asia Pac, Gujarat Rafia, Oro Labs, and one of my Beta Labs. So those were my initial pharma API investments, right? I wasn't aware of Orchid, Lupin, or Natco. So this is 93, 94, 95, Balaji Mines, and all the rest of it, random IPO. And I used to apply to all of them. And the thing was, your money is locked for an X period of time. And if you don't get the subscription, and they will return your money back. So the bad IPOs will get full subscription, and the good ones where the oversubscription, if you're lucky. So I was lucky in some of them, 2 banks and 1 chemical company, but I got full subscription because I was random, and daily you would find 5, 6, 7 IPOs. You need to fill a form and then submit it to your nearby bank or whosoever was the location. And then you wait for allotment day with a lot of excitement. And then after the allotment, you start turning Economic Times, because in the Times of India, the morning paper, the quotes were very limited, only the Sensex or the A group companies. So my journey started, and I started losing money one after the other. Few IPOs, so 10 rupee face value, listing at 8 rupees, never recovered. 10 rupee face value, listed at 11 or 12, went up. I waited, came back, disappeared, delisted, zero. So all of them, including SR Oil, we know what happened with the SR group, right? So then I figured out that, look, I've got this Global Trust, I've got this HDFC, and I've got this, which was the Balaji Mines. Because they will also collapse, they will also go to zero or disappear. So I better sell them as fast as I can. So I doubled my money in them. In Global Trust, I made a lot of money. So I still remember the price. I sold it somewhere around 93, 94 bucks. And then I was completely out of so I was still reading the Economic Times, and I was still reading, because my ego got kind of hurt that, how can I lose all the money? Something like famous story of Mr. Ramesh Dawani ji, right? I mean, he was in US, his dad gave him 10,000 or whatever the amount of money, and he invested in the hindsight view, right? And he lost everything. Exactly the same thing, but in my case, it was just the IPOs because I was not investing in secondary markets. And then luckily I found a broker in Lucknow, and I was working, and I used to just go there lunchtime or whatever, and just used to sit there. And so he used to deal with Kanpur. So there was Kanpur Stock Exchange was also there at that point in time. So he had a sub broker there. So he would call him periodically every 15-20 minutes to take bhav. What's the price of this stock? And he had that register, and he used to take the quotations of companies like Britannia, Wockhardt, Lupin, those kind of. So I still remember these three names. I 100% remember, and HDFC Bank. And then so I sold HDFC Bank quite cheaply, and I remember one of those days. I'm not sure whether it was late 90s. Yeah, it was probably 98, 99. HDFC Bank was locked at upper circuit of 84, and I was cursing. I was kicking myself. And I had 500 shares, not great, but in those days, I mean, 500 shares of HDFC Bank was a meaningful amount. So then I started asking him, why you focus on these 3, 4, 5, 10 companies? It was a good broker, obviously, not like what we find today. So he said, look, Sajal, I just buy small quantities, and then I get the annual report. So even if you buy 1 share or 2 shares of Britannia, you will get the annual report, and you read through those reports. It's a good read, and so on and so forth. So I also started through him, of course, that get me few shares. So I bought Lupin. I remember very early on, and I made good money in Lupin. So Lupin had 2 businesses at that point, and there was Lupin Chemicals, and there was Lupin as in just the Lupin. And Wockhardt also, I got interested. So I bought few shares of Wockhardt, and I used to love reading those annual reports. And somehow, I don't know, my inclination developed towards consumer businesses and pharmaceuticals, and maybe chemicals, but there were no chemical opportunities back then. But I made money in a chemical stock. So naturally, I was more comfortable. And then, so I slowly started learning about, what equity is all about, and that gentleman, my broker, also helped me. And then my journey progressed. I was fortunate that I got exported into US. So I was in software. So I used to do PL SQL programming, right? So sometimes I tweet and I write if else, right? So that's where I've still got that baggage, if you like. So I started earning good amount of money there, and I used to call him every now and then from US. So I bought few stocks, and um, I continued with my learning from there. 9/11 happened, and same organization where I was, they had opportunity in UK. So I was interviewed. Again, luck, random. I got into UK, and then I've been here. Serendipity happened so that a friend of mine said there is a guy called Ramesh Damani, and he interacts with investors every Tuesday on Rediff. So there was a website called Rediff in those days, and there will be a Rediff chat. So I said, okay, I will join. And it used to start sharp on time, and people used to flood with all the questions. And the Maniji used to respond as fast as this. It was all typing going on, I could imagine. And I started learning few things. So my journey was well on course. And if I remember what few things, stocks, I think, so I clearly remember one was Godrej Industries, that he used to suggest. So Godrej Industries was a console business. It was not demerged. So later the demerger happened into Godrej Properties, and I think few 3, 4 other businesses as well. So there was another one which had McDowell, of course. How can I forget McDowell? So it was literally right in front of my eyes, 200 crore business. McDowell, which is USL, United Spirits today. And then I know which micro caps. So again, all of these are 100, 200 baggers and multi-baggers, right? So don't buy them today, but I'm giving you those names just to prove the point that he was a legend and he was doing this social service free. So Iron Exchange, he introduced ITHL, which was the ITC group travel house, international travel house. Mazda, there was a company called Mazda Limited. Then there was a Taneja Aerospace. What else was there? One or two small names. LinkPen was another one. So on. So he used to share many things. The key lessons, other than the stock names, of course. So I bought some of them, not all. The key lesson that I learned early on from Mr. Damani was that you should try and value the whole business. So market cap, what's the market cap? And if there is debt, what's the enterprise value? So I learned that formula that enterprise value is market cap plus debt. What's the price to sales or market cap to sales or EV to sales? What's the price to book? So he used to talk in those terms. Will you be buying the whole business? What's the value of this whole business? So in today's term, Divi's is 100,000 crore market cap. That's the value, right? So the fundamentals were kind of so deeply drilled into me that I'm still kind of, that kind of old school investor. And you guys, those who follow me, I always talk in terms of price to book or price to sales. What's the size of the opportunity? That's another thing that I picked from him very early on, that you should always look at where the business is today, what's the size of the opportunity, and then see any early indicators of whether that business can tap that opportunity. So that's where my journey started. Long story, but I thought it's important to highlight that I was a very stupid, very speculative investor. Get rich quick, typical mentality. Bull market going on, khareed ke, and then you will become rich in a jiffy. Anyway, so let's with that sort of background, let's move on. So power of in the context of counter confirmatory evidence, absence of evidence, AOE, is not equal to evidence of absence, right? So you have to have that very negative kind of a mindset, because then you will ensure you get high margin of safety. Because if it's in a bull market, if you're in a bull market and if you're valuing something, margin of safety may not be good enough. Asset is already inflated. So you need extra margin of safety there. Error of confirmation or narrative fallacy will always be there. If the business is doing good, the narrative will invariably be first class. So halo effect. There was a halo effect in Cisco at one point in time. There was a halo effect in, what was that research in motion stock, BlackBerry. 50 bagger in 5 years in a jiffy, and then boom, finish, game over, collapse, right? And so any stock at highs will create a halo, and any stock at multi-year low will create a negative halo. Your job, or our job as an investor, is to figure out, is that the right sort of, is number matching the real number, not the PNL or the media number, right? The real number. So in case of Newland Labs, I used to see the real number, which for me was their CDMO synthesis or CMS division. How is that progressing? Street was throwing me levricitam, or Twitter was giving me that name of levricitam, generic, low PNL, 16 crore, I think, was the PAT a few years back in Newland Labs, right? So that was also, there was a negative halo in that. Many examples. The cyclicals that have recovered, whether it's Apar Industries or any random name you pick, when they were at their lows, the narrative invariably would have been negative. So that's what I wanted to highlight. Anyway, let's move. So it should be, if you are recruiting someone, I don't know whether he's a good candidate or not, because I need to test that person out over a period of time, 6 months at least, right? So I'm not too sure how good that person is, but it's easy for me to figure out if this is not a right candidate, and how many jobs they have switched or what they have achieved in their career previously. And exactly the same concept we have to apply for a business, where they have come from. how much transformation they have done, how long it took them to make that transformation, how strong is the leadership, are they do they walk the talk, so on and so forth, right? And that's where if something is and it's easy to figure out what is not deep value versus what's too expensive. So negative knowledge is more robust. Question that I still ask all the time: how can this business be killed? How can I kill Syngene, as an example, right? Why will this business sustain? Where is the operating cash? What's the status of the balance sheet? How big is the debt on a normalized? So if I find a business that I expect that 1,500 to 2,000 crore operating cash will come when the assets are reasonably utilized, what the debt is in that context. So you need to see if because any business that will sustain or that can sustain will grow, give or take, right? And if you want to be 100% sure, you don't know, and you have got very limited experience in the market, go for debt-free businesses. I mean, the worst you will lose is the opportunity cost, that in the business you may buy it at an inflated price, and it may take ages to come back to that price. But a debt-free business will not go to zero. Syntex went to zero because it had debt, and the management was also unethical, fraudish, right? So that if had Syntex been debt-free, it wouldn't have gone to zero, as an example. So in leadership, if it's an overconfident, arrogant leadership, poor execution track record, not interested. Chronic high debt. High debt for a brief period. So remember what we read about the stressors. Short period of time, and then you get recovery, right? So chronic high debt is bad. Low free cash over a period of time, that this business is so indebted that they end up paying interest and taxes and maintenance, and not much is left for free cash. So free cash definition is, and we'll come to that later on as well, that whatever the operating cash is, what you have to spend or release to stay in business, not the growth capex. Growth capex is not included there. But anyway, limited control on pricing and volumes, a typical unbranded business. Any business which is unbranded, you don't control the pricing. You may briefly control the pricing or the volume, because if you are an early mover or one or two players, so those kind of businesses are generally get very negative about. Import alert on multiple plants. So imagine you have got Wockhardt scenario, you've got high debt, and then you've got balance sheet issue followed by import alert on multiple plants. That's an extreme event, right? And it will not give you any time to react. That kind of a scenario, and then the explosion will be so big and significant that you may not be able to recover. Moving on, so again, bull market, classic example. If I need a microscope to justify valuations, either to myself, or if I'm in a debate and someone is challenging I need to do DCF microscope, I've lost it. I'm not interested. Sell fast, buy slowly. If there is a bad news or there is a change in thesis, management change, there's a whatever, it could be any event, and if it's kind of permanently, that's a judgment whether this event, a serious event or an extreme event, is it causing a permanent damage to your investment thesis, or it's a temporary phase. If it's a temporary phase, like what happened with divis, like US FDA 2017, you should be prepared. As long as you have done your homework, you should be prepared to add more. So if you are buying a new position, go very slow, because a small position, even if you lose 100%, it will not cause you any sort of serious pain, hopefully, you need to sustain, right? And busted stock, whether it's kind of a IPO, and a lot of IPOs, they come down 50-60%. Not every IPO. So if in a basket of 10, 15, 20 IPOs, you will find at least few, maybe 50%, that they will come to your sort of reasonable expectations of valuations. So that's how I got into Laurus Labs in 2019, Glenmark Life Sciences, Narayana Hospital, many examples. But I couldn't buy DMart because that never crashed 50%. So that's fine. I mean, you get 2 or 3, and that's enough. You don't have to eat at every restaurant, right? And so no material damage to long-term fundamentals. We have to focus on the long-term fundamentals here. Um, Always invert, and that's what I do. So the narrative is that India is a young country. I would invert it. What it means 5-10 years out, at the middle part, people crossing 40, people crossing 45, people crossing 50, 55, and so on. And I've included the link. You could see the demography, the demographic dividend that we speak about today, 10 years out, it will start adding a lot of people above a certain age barrier, right? And that's why I believe that healthcare will be a big opportunity, and senior living will be a big opportunity. So that's one. And the consumption pattern will also shift. So a young person will consume different things, and a senior person or a middle-aged person will get more into healthcare, education for children, that kind of. So I believe, in my head, I've got a very strong conviction that education and healthcare are infrastructure sectors. This 80-20 rule of Pareto, it doesn't exist now. It's 99-1, because the extreme event will be so powerful, that it will. So in my case, all the IPOs that I invested, had I done nothing for 25 years, absolutely nothing. So I logged the keys, and I can't touch it for 25 years, all of them. So let's say I invested in 100 IPOs, or I don't exactly remember, it was no less than 100, but let's say it was 100. I only got 3 winners, or 2 rather, because Global Trust also collapsed to 0. So excluding Global Trust, I only got 2 winners. One was Balaji Mines, and the other one is HDFC Bank. Off the top of my head, so Balaji Mines face value 10, 35 rupees premium. This was 90s, mid 90s. It got listed somewhere around 45, and it was hovering in that 35, 45, whatever. And imagine I left it alone. I think it's about 1,000, 2,000 bagger, if I'm not mistaken. It's a huge multi-bagger over a period of 25 years. So time, you need to give time, right? And so good things will happen. A lot of bad things have happened in India. A prime minister got assassinated, wars, currency problems, right? So 2013, there was a run on the rupee, September month, terrorist, Mumbai and elsewhere, a lot of bad things, riots, whatever bad could have happened in India has happened in the last 25 years, and multiple wars. And still, if we find this index has compounded, and the businesses have compounded, and then I'm giving you a random basket of 100, and in that 100, only 2 stocks. Even then, I recovered my money. Not just recovered, I made a multiple of that. Again, 25 years adjusted for inflation, all the rest of it is not great. But what's the probability of me using a framework? Because I was not using a framework back then. So my data is not a good representative data, right? I mean, if you know what you're doing, if you pick 100 stocks, there's a decent probability that you will get at least 50 or 40 or 30 good ones. And they will be, because downside is capped anyway. Downside is your floor. Stock cannot go below, so 100 rupees stock with high leverage on the balance sheet, extremely high leverage bank, as an example, it could go to 0. But 100 rupees stock over a 25-year period could go to 10,000. Who knows? So it's very asymmetric. We have to avoid 0 in any segment of my thesis. When I say any segment, I mean business management is starting with management, then industry structure and business valuation. I mean, I'm happy if I go wrong on valuation. I don't want to go wrong on management because that's my 99 and 1. Management is my 99. So I don't want to go wrong on management. I can take hit on the balance sheet, debt or whatever. But management is the single biggest zero in my thesis. So that I want to make sure that, you know, if I'm having an exposure, management is decent. And again, I may be having 1%, 2% below, or not 2%. I would say below 1% in a business where I've not figured out the management. But then even if that stock goes to zero, it will not cause a significant dent into my overall portfolio because stock doesn't matter, it's the portfolio. And I also try and challenge my thinking that, you know, can I buy 100% of this business? So if I've got unlimited amount of money, will I buy whole Divi's Labs today at 100,000 or thereabout, right? So I always go with that mindset, whether I'm buying 100 shares or if I'm buying 100,000, doesn't matter. I have to have that mindset that I'm buying the whole business in a cash transaction, and market is throwing me a random price. So the price of Newland Labs was 250 as well in last few years, and I've seen 7,000 as well. So market is throwing me random prices. At what price will I be prepared to buy 100% of the business? And the idea is not to be a turkey. Don't get harmed by random events because random events will increase because the world is getting increasingly fragile, believe it or not. More random events, more extreme events will happen, and you cannot imagine what can happen, both on the positive and also on the negative. But positive black swans are extremely rare. You will get more negative events versus positive events. And so assume that 0 to 1, because if management is 0, management change will not happen. So 0 to 1 is a bad management. So although JB Pharma was not a bad management, it was okay-ish, I would say, but I got a 1 when the management change happened. Same for RPG Life. But assume that 0 to 1 will never happen. And then what is the price you are paying? Are you comfortable with that as a valuation? I think, are there any questions, Ankit, that I'm happy to take?
Sure. So thank you so much, Mr. Sajal, for kickstarting the session with a very good set of slides on your way of looking at businesses, specifically in the uncertain environment. So now I was about to ask you, but you have already covered that regarding your initial journey, how you. But
yeah, if
yeah.
you got any sort of follow,
But
I'm
one,
happy to interact. I want this to be a very interactive session.
yes. So basically today's session is titled as Unveiling Business Vulnerability, Metrics for Assessing Fragility. So before you take the slides, because that's the topic of today, and I have purposefully not defined the topic. So I would think that it would be better if you could maybe start with explaining this, because many new investors might not be well versed with this particular topic itself. So maybe you can kickstart with that, and then we go back to the presentation. Yeah.
Sure. Are there any sort of questions? I'm happy to take if there is any sort of pertinent question which is on the slides that I've already covered. I'm happy to take them. Otherwise, I'll just move on.
As of now, I have not seen any question from on the chat box.
Okay.
There have been a lot of messages related to they have enjoyed the session so far. There's one
Excellent.
question which I get right now is how do you decide selling? As in,
So selling, I'm not super, but I'm not Pulak Prasad. Let me be very clear. So I'm sure you must have read that Pulak's new book, right? What I learned from Darwin, what I learned investing from Darwin. He says we are permanent owners of the business. So I have got businesses like Newland Labs as an example, where I've stayed invested for 20 years, and so is the case with Biocon. But I'm not I'm not a dogmatic person that, I will not sell it at, if I get a good value, which I believe is significantly above my sort of best assessment, and there is another business which is good. It may not be a great business. It's a good business which can become great, but the valuations are a throwaway. I will switch. So that's my one criteria for selling. The other, of course, is if there is a fundamental sequent, as an example, it's well documented in the book. If there is a break in my thesis, whatever be the external event or trigger, I don't care whether I'm sitting on a loss or a profit. If my thesis has permanently broken, um, and that's a judgment, right? You get that by making a lot of mistakes. So experience comes from making mistakes, and luckily I've made a lot of mistakes, and my tuition fee was very small, despite so many mistakes. So make small mistakes, make them as early as possible, because then you don't sacrifice your compounding journey. But yeah, if there is a break in thesis, I'll sell. So sell if it is in a better opportunity, sell if there is a break in thesis, sell if I need cash for whatever reason. If I need to liquidate a part of my holding and buy, a house or a land or something, I would typically, I think these are the three scenarios. Otherwise, my capital is always long term. So my long term is 2047 or beyond, or when I'm no more. That's the kind of my definition for long term, but it's not business specific. There's a difference. My long term definition is for the capital, the risk capital that I have got. That's for decades. um, that doesn't mean that the business will be with me for decades, because a lot of random events will happen. If the business is, so Wockhardt as an example, what was anti-fragile became fragile. I'm not interested. I'll sell. Any other?
Yeah, there are a few questions now. So there is one question by Sharon. He asked, why doesn't anti-fragile businesses move? For example, FMCG companies, Dabur, Marico, that have excellent management, they try with new product innovation, but they are stagnant on growth. But these stocks don't move for years. No
Yeah.
returns for
Okay.
many years.
No, good. This is a very excellent question. Just a quick clarification. So consumer businesses are typically robust, whether it's Pidilite or Nestle or Dabur or Marico or Britannia, the Tata Consumer. They're all robust, but any business, any management can show anti-fragility in the sense that if they make a mistake. So if Dabur has committed a mistake, the market will give them feedback, consumers will give them feedback. If they learn that feedback, and they will improve. The magnitude of your mistake is also important. If you have put the whole business on the block and you lose it, then it was a large magnitude. You don't survive to learn any lesson. See, the dead person will not learn any lesson, because there is no volatility. The person is dead. The business is dead. Syntax cannot learn any lesson now, right? You're dead. So the feedback should be small in magnitude, and the management should be willing to accept that feedback, whether it's coming from inside the organization, employees leaving as an example, there's a big churn, that's a signal, or it's coming from a regulator or customers, or whatever. You learn those small mistakes, you learn from them, you become anti-fragile. So even in consumer, so Narayana, I believe their insurance foray is an anti-fragile move, in the sense that their downside is very low, right? And the upside is wide open, almost like an unlimited opportunity over a 20-30 year, when India will not be having the same demography. So even in consumer, and branded healthcare is also a consumer, essential consumption, right? Small ticket items, you don't need a bank loan for these. But typically speaking, a branded generics business or a hospital or a Nestle or that kind of a business will be robust, because if there is a volatility, there's a lockdown, you cannot consume Nestle products. But as soon as the lockdown is, because the demand doesn't go away, the demand is there, right? So any business will make mistakes. Stock always, people get too hung up on the stock. I mean, has the earnings improved? So rather than talking in terms of the stock hasn't done well, I mean, what's the what have the earnings done? So I'll give you one example of Havells India. If you look at the profit, I'm talking about operating profit here. Off the top of my head, organic, inorganic, because Havells has done acquisitions as well. Over the last 10 to 12 years, I think their operating profit is about 2.4 or 2.5x. So 600, 700, 800 crores to 1700 odd, right? And so 2.4x over a period of 10 to 12 years is not, I mean, nothing great. I mean, it's kind of average or maybe below average, depending upon how you see it. But Havells as a stock has done exceptionally well. And why is that? The reason is their starting valuation was low. And so you bought value and then growth happened. So there is a lot of correction. So market got the feedback this time from Havells. So Havells gave feedback to market that, look, I'm not doing as bad as you think I am. You need to give me a better discounting. So the feedback came from Havells to market, the other way around, and market re-rated them over a period of 10 to 12 years, right? Again, this is just discussion, and there is absolutely no recommendation, given the disclaimer upfront. But I wanted to highlight this, and same thesis for any sort of. So Tata Consumer as an example, if they are improving, we have got a case study for some consumer companies further down. So let's not delve too much time into it. Any other question before we progress?
Yeah, there are a few, if you have time. So
Any important ones? I'm happy to. Maybe you can club them together if they are similar.
yeah, one question I would like to say, because I think this is very interesting. So Jivesh asked this question: when you say management is the first concern, how do you look at business that's at a very good, attractive valuation, but has corporate governance issues in the past, and probably the management has learned their mistakes from the past and are not going to repeat those mistakes?
So I like that those managements who have. So if you have made a mistake and if you learn the lesson, and you are less fragile relative to the management who has never made a mistake. So we don't know what we don't know. So between a management who has never made any mistake, that management is fragile or brittle relative to this management that this person is giving an example. Your judgment lies in making sure that they have actually learned that lesson. And because you don't know if they have actually learned the lesson or not, you have to have a very high margin of safety or a stop loss or something. So do not assume that your analysis and assessment is correct. What if, right? So have a margin of safety, deep margin of safety. And then if that management is actually transformed, so fragile management becoming anti-fragile in this case, it may or may not be. We don't know today. We'll probably find out at a later stage. So you keep your downside minimum and you ride that. So that's one. The other is you also look at the industry structure and the business. If it's a cyclical, by definition, you cannot be a buy and hold investor. So you have to have, a period that, the cycle is reversing maybe for 6 months, 12 months, 18 months, whatever. And there will come a time when um, a cyclical will start looking like a Nestle. At the top of the cycle, it might give you that impression that this is not a cyclical. That probably is the time to sell. And when you don't want to sell, if you sell there, 9 out of 10 times you will not probably lose money and you will make a lot of money and the cycle reverses. And the flip side is buy when you don't want to buy.
Right. Very well
Okay.
covered. So there
Yeah.
are a few questions related to directly about businesses, different businesses. Tell us about this company. I'm ignoring those.
No, yeah. So let's crack on, Ankit, because we might be covering all of or some of those questions, and then
Yes.
maybe after a few slides we'll take another pause.
Sure. But you can keep your questions coming in on the chat box.
Yeah, sure, please. Yeah,
We'll again take them up. Yeah. Yeah. Over to you, Mr. Sajal. You can go ahead with the
sure.
presentation.
So assessing fragility. So fragility is a function of industry structure and also a concept system versus component. So before I give you industry examples of this first point, system versus component, let me give you a natural example. So let's start with the nature itself. 100 million 100 million candidates, let's call them candidates, 100 million candidates start a race. And at the end of that race, there is, of course, there is only one winner, right? So the probability of success is 1 in 100 million. And clearly the winner takes all. Um, and 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 the sperm is the winner here. So sperm is one sperm that is fertilizing the egg. 100 million start the race, right? And there is one winner that fertilizes the egg. Winner takes all, right? So what's happening here is the whole 100 million lot was fragile to begin with. The DNA, the code was anti-fragile, and the winner got into that. So the nature is saying that we have to kill fragility. Nature is giving you a feedback that, we have to kill fragility. So 1 in 10, 1 in 100 million. Compare this to the real world scenario in life sciences, drug discovery, innovation. It's not 1 in 100 million. It's a lot better ratio, but it is still what? 1 in 10,000, as good as zero. So if the component is fragile, so sperms in this case, or if we take an example of, let's say, CDMO industry, consumer durables, banking and financial services, right? So if the components are fragile, so I believe if India has got 5,000, 4,000 microfinance companies, small banks all put together, and globally if there are thousands of small and micro CDMOs, which there are, industry is very fragmented in both cases. And if I throw white goods, so television, refrigerators, air conditioning, kitchen, cookware, whatever, you find umpteen number of players. So there's a common characteristics in these three industries: CDMO, banking and financial services, assuming that you've got many small players and many sort of consumer companies. As long as they are fragile, so the competition keeps eating each other out, the overall system or the overall industry will be anti-fragile. So where the components are fragile, same for restaurants as an example. If there are many restaurants in your local area, all of them have to be fragile so that you get the best possible quality of food as a consumer. So the industry structure is anti-fragile, and vice versa. So let's take an example where a country has got only 3 banks or 3 or 4 infrastructure companies, all government owned. Let's make it much more interesting. So they are very robust because there are only 2 or 3. It's an oligopoly market, right? But what kind of service will they give you? Right? So if where the industry structure is anti-fragile, consumers take the hit. So ideally we want industry to be fragile, and just like the sperm example, if you're not fit, you will die, because sperm spends a finite period of time in an alien or a foreign body. So I think it's anywhere from 45 minutes to up to 12 hours it may take to fertilize the air. So you have to survive, you have to sustain, and if you are fragile, you will die. So nature, and that's why I say, I keep repeating, and I've said this in the book as well, that fail fast model. Fragile has to, so kill them as fast as possible, and whatever is left over is anti-fragile. So I'll give you another example of antibiotics, right? So when you take an antibiotic, there's a saying that what doesn't kill you makes you stronger. That's a fallacy. What doesn't kill you is killing someone else, in this case the microorganisms. So you are relatively better off, you are relatively robust or anti-fragile relative to that person who died, in this case the bacteria. So that's another example that if something doesn't kill you, so albendazole, right, a drug that a company makes, it's a deworming drug, right? So a child takes that drug, the child doesn't it doesn't cause any sort of harm or suffering visible, at least to the child, but it kills the worms inside their tummy. So what doesn't kill you is killing someone else. On a relative basis, you are becoming robust. So that's the kind of industry structure I want to see. I want a very fragile industry structure where the system, so it will fooled by randomness that, CDMO as an example is a fragmented, it's a dirty industry, but that's good because, only the good businesses will survive. How many Syngenes are there in India, as an example, right? Um, so that's what I like to see. So that's how I measure fragility, and I want the complete history and geography of the business and the management. Who started it? What was their background? In which year it was started? Right? So Laura's Lab, I know where Dr. Satya was previously. So a company called Matrix Labs. The reason I know that because I was early in my journey, and this was the period of Rediff chat that I was talking about, 2002-ish period. And the stock of Matrix Labs exploded like anything. And I sold it very early because, again, my rear view mirror was that, sell as fast as possible, book your profits. I was in that mindset. And it just went on and on and on and on and on. And it was a very significant, massive wagon in a very short period. 10, 15 years, it was kind of 20x, 15x, or not 10, 15 years, within a period of 15 to 18 months. So 1 year plus, it was 15x or 20x, whatever. The other person who was there in Matrix Labs was the Glenmark Life Sciences, Dr. Raoji. So you have to have a complete history and geography that, where this promoter has come from, what they've done in the past, what has been the history of this, how much distance this company has traveled. So Newland, as an example, was a commodity API predominantly 10 years back. Today, they have got very complex synthesis molecules, 20 step, 30 step, and of course, the innovator synthesis. So the distance they have traveled and how much time it took them to travel that distance, all that must be taken into consideration. The other measure of fragility, which I practice, is I look for optionality. I've explained this in the book. And low downside, large upside, that's anti-fragile. Low upside and large downside, that's a fragile trade to begin with by definition. And then optionality is small experiments. So start a pilot plant, test out your experiment, scale up, and then once you get the approval from the customer, you can go at a bigger capacity. So large scale opportunity, if you make a wrong judgment as a management, that will cause a more pain. So doing R&D for 15 years and then failing in phase 3, or doing R&D for 15 years, launching the product, and then you find out, there was something, an accidents happened, and I'll give you some examples, legal litigation or whatever. So that's a very late feedback that you got after spending, a lot of cash. That's not optionality. And the optionality means small experiments, small investments, and then you wait for the feedback, you learn the lesson, and you only scale up the good ones. So again, sperm example, you only scale up one and everything else dies, and you create magic. Again, another measure of fragility, is concentration. Any kind of concentration, that's a sign of fragility. Concentration in debt, excessive debt we are talking about here. So Biocon is an example. Concentration in customers. So PI has got one or two customers that are disproportionately giving it cash flows. So fragile cash flow source, fragile scale or scope of opportunity. So single market, or 2 or 3 markets, 2 or 3 customers. That's a sign of fragility. 400 customers, again, Syngene is an example, or hospital. How many customers a hospital has? So the concentration is not there, right? And if a hospital has got good balance sheet, sustainable sources of cash flow, large pool of customers, it's fundamentally, it's kind of either robust or anti-fragile. Again, are you as a management willing to take that feedback, make changes? And transilience is, if you watch basketball, a player passes the ball keeping one foot planted. So they change direction, they will pass the ball, but they will not be jumping in the air. So transilience is transforming while staying resilient. And And probabilistically, last 10 years can be extrapolated into next 10 years if you know the industry very well, because history will seldom repeat. I've seen commodity companies in their last 10 years becoming a specialty and very different. Newland again as an example, right? Um, but you cannot take that as a granted, especially if the last 10 years are rosy. You got to be very careful. That next, so chemical, 2021, everyone was gung-ho, everyone saw, all the examples, from Neogen to whatever, random name. There was so much strong hindsight bias that, last 10 years will get extrapolated into next 20 years. That's how you get 80p, 60p, 50p. The market is saying nothing will change, world is not fragile, and the boom will continue forever. That was the time when the IPOs started kissing the market. Clear signs were there for someone who had that sort of judgment. It was all there. Again, competition, winner takes all. Again, same example, sperms. I mean, how many quality white goods or consumer durables companies are there in India? Is consumer durables a winner takes all market, or gold jewelry? It may not be winner takes all, but there are 2 or 3 dominant players. Titan being one of them, there may be Kalyan Jewelers and few others. So in that case, winner is not taking all, but winner is taking the disproportionate share. That's what I mean. Collaboration. So it was a collaboration between the sperm and the egg. So collaboration can create magic, right? So collaboration between a CDMO player and an innovator can create magic. CAR XT as one example. Then CRAS mutation. I mean, CRAS mutation was an area where it was deemed undruggable, because for 40 years there were no drugs possible, and then Syngene cracked it with Amgen. So if a company has got that level of competence that it can make the impossible possible. So what was undruggable, the scientists of Syngene and Amgen put together, they made it possible. Another example is Austedo. Before Austedo came out, there were no deuteration chemistry-based drugs in the market. It was a first time, right? 2017 was when the Austedo, FDA approved the Austedo. So again, classic example that undruggable became druggable. And any company, any player in that sort of a value chain will get market attraction at some point. And Newland's profit, if I'm not mistaken, few years back was 16 crores, just 16. And narrative was leverage generic commodity. From 16 crore, today we have got 300 crores. Significant ramp up, right? So collaboration is also good. Winner takes all, if you could find, but there are very few opportunities. Competition is for losers, because Biocon is losing on the generic competition. Biocon created Syngene. Same management, 2 very different outcomes, right? This is again very important criteria, which is, so X is the uncertainty, X is the unknown, X is the unknowable. How you reduce fragility when you don't know the future? Future is unpredictable. You don't know the future. It's unknown, unknowable. You cannot control uncertainty. You cannot control X, but what you can control is Fx, or a function of X. And here is the example. X is regulatory audit. There is an uncertainty. You neither know the timing when US FDA will visit your facility or the outcome. Both are unknown. And if someone is telling you the answer, liar or God, only 2 people know the future. Only 2. And I'm neither. I accept that I cannot predict the future. Absolutely. And I don't even attempt to, right? So I want to be inverse Turkey. I'm not predicting. So I cannot control the timing or the outcome of that event, regulatory audit. What I can control is the impact on my cash flows. So if I'm compliant, I'm not like that Wockhardt, right? If I'm compliant, regulator can come at any point in time. I may get one or two observations, which is a feedback, a small feedback, small stressors are fine. I'll make the changes and then I will make a new high. So that's fine. So I have to control my impact on cash flows. Other example is there is demand uncertainty. I don't know whether the innovator will ask for this product again next year, or I don't know whether this product will be successful. So there is demand uncertainty or the product uncertainty. The project may so molecule is in phase 2, molecule may die tomorrow. So I lose that project. So there is absolutely no certainty there. How can I transform X into FX? Because FX is easy to control. In this case, for demand uncertainty, it's optionality and fungibility. So if my reactors are fungible, I can make another product. If my scientists are fungible, even if I lose one project, I could deploy them onto a new project as an example. So that's another way to control the FX. Moving on, cost structures, high fixed and high operating cost versus low. So if it takes 10 years to put or a 5-year to put a greenfield plant, get it validated, operationalized, it's giving you a very high sort of fixed cost and a very delayed gratification operating cost. So think about that as the industry structure. How many players will be interested in burning their cash for 10 years setting up a biologics facility? And Zoetis deal may never happen. How many? So that's telling you something. Is market is giving you feedback. You may or may not take it. Flip side, the fixed costs are low and operating costs. So consulting business, four people, right? It will get flooded. It will get commoditized. There will be, so a lot of PMS is easy. If you have been a fund manager with a fund house or a mutual fund, you have had 5-10 years of experience, right? You can start your own PMS, because your fixed cost, you may have 5 clients to begin with, right? So it's a low operating cost, low fixed cost. There will be many. Where the fixed costs are high, where the operating costs are high, nobody will be willing to put a greenfield capacity and then wait for. So Laurus is an example. It tells you, market is giving you that feedback. We may or may not accept it. Second is this turkey problem. So guidance, dreaming. I've explained so many examples in my book, right? Inconsistency in execution, walk versus talk. Right? You're giving false impression. You're guiding something, you're not delivering. You're guiding something, you keep guiding, you keep failing. So Wockhardt actually stopped doing earnings calls. So previously they were doing earnings call. In bad times, they've completely stopped. They do one random presentation here and there if they need money. If they need to raise a QIP, they will do 1 or 2 presentations. There will be news flow, there will be chatter. The people will get interested. There is no consistency. So walk versus talk. Tweeting about stock or market cap. Classic example that, I want my market cap, we are undervalued. And let's not name, those who have been in the market long enough know what I'm talking about. So we are undervalued, our stock is undervalued. Obsession with non-business affairs. So, any conclave, any debate, you happen to be the person there. So anything to do with the execution of your business. You're not delivering on ROE and ROC. You are delivering something else. You want awards. You're more interested in that kind of. So again, classic signs of fragility. Media appearances outside result season, frequent. Quarterly. You may come on ET Now. You may come on Bloomberg once every quarter. It's good to interact with, because investors want to know. As long as you're not giving any guidance, or you have learned the lesson, you are previously giving guidance, now you have stopped giving guidance, that's a sign of learning. That's a sign of humility, that you have taken a feedback and you have changed course, you're pivoting. Where management, if I know that management cannot be fixed, nothing else matters. Even one-time book value, if I'm buying something for 5-10 years, I don't care. I will not, because management is 99. If management cannot be fixed, no point. Um, Time and Lindy. So Pidilite, if something has survived for 50 years, I don't know when the IPO of Pidilite came, but the business was in existence since 1960, 65, thereabout. So Lindy effect. There is a magic product which, if you consume that, you will be robust. And it's 200-year-old product. It's widely available. You can have it, and the property of that product is, when you consume that product, you feel better. It's Johnny Walker, 200 years, right? So Lindy effect. So in other context, anti-fragile to fragile will be a function of time, and fragile becoming anti-fragile will also be a function of time. So time is the most. So that's why they say, don't time the market, give time to market. A lot of good things will happen. Small down impact. A lot of good things will also happen with unlimited upside, and your overall portfolio level impact will be fantastic. I must caution that whatever I've given is not a comprehensive list, but I'll let you read it, and I'm happy to take one or two questions before I go for a quick comfort break, Ankit, and then we'll resume. But I'll take just one question, and then we'll take a break, because I think it's about 90 minutes. I've not taken a break.
Sure. So first of all, thank you so much for taking time out and working. So like many people were texting me that will it be similar to what you have presented recently on another platform? So I assured them that whatever Sajal ji will present, it will be completely new. So thank you so much for taking time out and working in a very short notice. So there have been many questions asked, but since you asked me to pick one, I'll just pick one which was asked a little while ago. He's Ishan. He's asking, how do you look at Piramal Pharma at price to book of 2? If they can grow at 12 to 15% with operating leverage kicking in and reducing debt over a period of time, how negative is them having 17 to 18 sites spread across the world, and most of it is non-fungible, I guess. Could you please share your views? I know it's a company specific, but I think there
No,
have
I
been
can.
many.
I've tracked Piramal, and I've spoken previously about Piramal a lot. They made one or two mistakes, and it's all documented, right? So accidental investor, we have done spaces about a year back, or last year in January or February. I gave my so I'll give you a quick sort of take. So Piramal Pharma is a collection of businesses. It's not a pure play CDMO. The other two businesses are better, actually. So there's a branded business in India, which is where women and child healthcare, OTC based, pretty much, right? So that's a good business. It's not giving you margin which will be the steady state margin. So over a period of time, those margins will improve on the branded business in India. The hospital generics business is also a good business, because I believe Piramal Pharma is the only business that has grown hospital generics over a period of 10 to 15 years, when the whole pharmaceutical industry was struggling. Now everyone is singing and making a life high, but take a 10-year, and not many businesses would have grown their top line, generic industry top line, by 10-15%. Piramal Pharma is an exception. Their hospital generics business, beautiful business. Those are the two good elements. Management, I think, has also learned the lesson. Again, we don't know whether they have or haven't, and we will not be able to get an answer immediately or maybe next year. You have to give them time. There's a workflow in this space. Give them 5 years, 7 years to to um, to give us credible signal that they are committed to reduce debt, because I think they've still about 3,000 odd crore of debt, which I think is high. But on the CDMO, I'm not too sure whether you comment on Ishan on fungible or non-fungible. I think most of their facilities are fungible. Again, I could be wrong. So do your due diligence. I'm just giving you my sort of, I don't own this stock. So I've got no investment there. I think they've got near shore presence because they've got many facilities in UK and US, but that's an advantage. But there is also a negative element in there, because if your capex and opex are high, your ROE and ROCE will be low. They will be suffering. So if you look at the console ROE and ROCs, if you go to screener and see ROE, ROCE of Piramal Pharma, they will be low. And I doubt if they will show you the 30-25% ROCE anytime soon. I don't expect 25% ROCE in next 5 years. Again, I may be wrong. Again, it's a probabilistic assessment. So CDMO is the business that is kind of giving them pain. If this is a three kind of business, so they are branded business, branded OTC business in India, separate. Hospital generics is a separate one, and the CDMO is a third one. The least preferred as on today is the CDMO, but you're not getting all three together. You're getting all three together, not separately. So the only debt is one negative. The other negative is sustainably poor ROE, ROCE, high depreciation, which is the nature of the CDMO business. But yeah, my top two concerns are debt and low ROCE. And I think Dishman, again, very similar business, overseas operations, high debt sustainably, and they keep that, they say it's a low interest or whatever, but their ROCE is poor. I mean, Newland's ROCE was 4%. Today it's 30% if you look at their last presentation, right? So I like those businesses where I buy the value and then growth comes. Piramal or Dishman, I don't have the confidence today. I've got a small investment in Dishman as a disclosure, but I'm not positive as on today on either of them. So that's my sort of opinion at the moment. So I think with that note, I mean, you keep looking at or screening or bunching if the questions if you can, and I will get back in about 5 minutes or so. Okay, Ankit?
Sure, Sajalji. And thank you for bringing in Dishman Pharma as well, because there were questions related to that company.
I thought so, because they are very similar, right? Yeah, the complexion of both high debt,
Right.
both have got overseas operations, both have got low ROC,
Right.
both have got a lot of promise but no execution. So yeah, there are a lot of similarities. That's the reason I said. And please note my disclosures. Thank you.
Sure. So, Sajalji, when you come back, you just let us know.
Sure. Yeah, sure. Will do. Thank you.
Thank you. So, thank you so much, everyone, for joining in. And you can, I'll just help you out with one thing, that maybe rather than just writing about one company, how is this company, you can probably frame your question related to the concepts which Mr. Sajal has already presented. I think those questions will form, will make it easier for us to ask to him. And as we have limited time, we'll probably bunch up these questions and take up the ones which we think Mr. Sajal would feel more happy to answer. Yeah. Having said that, since Sajal sir is coming, I'll just take this opportunity to show what we do at Mission Smile. You can see here, this is our platform. I hope my screen is visible to all of you. If anybody can just explain, share it on the chat box. Can you see my screen? Yeah, thanks everyone. Yeah, so I'll just come back here. So this is our platform. We started this platform in January 2021. So more than 3 years have passed since we have started Mission Smile. Over here on the left side, you can see the different activities we do at Mission Smile. So number one is Mission Smile webinars. Every month, we at SmartSync Services do our own research and deep dive on one particular business and share it with our community. So you can see here, there are a few over here you can see sectoral analysis. And then when you go down, you will see company analysis. So I'll just go down a little more and to give you a flavor as to which all companies which we covered recently, right? So India Mart was covered last month. We covered UFO movies in the month of January. We also covered Tega Industries recently and Wonderla Holidays. Supreme Petrochem, just for your understanding, we covered it at a time when chemicals were not doing well. And you can go back and see the industry where Supreme Petrochem belongs. Those kind of companies are actually doing well now, despite chemical as a sector not doing well, right? Then there is Triple S Ki Pathshala, where we share our understanding on different concepts with case studies, and it will be very interactive, where you get to know a lot of things which you have learned in books, but they don't work in the market. So we have taken live examples how. So for example, high P doesn't work well, low P works well, or something like that. That will be covered in P ratio session. Okay. So that is Triple H Pathshala. Then we have a session with Mr. Atul Rawat every month. We try to have it every month, but some month we may skip because of his busy schedule of meeting management of. So for people who don't know about Mr. Atul Rawat, you can just go to our YouTube channel SmartSync Services and sort the videos on the basis of most watched video. The video which comes at the top in terms of most watched video will be Mr. Atul Rawat's video. He is someone who has spent 30 plus years investing only in the microcap space. And we have been fortunate to have him with us. So we have him almost every month, where he share about some concept, some case studies related to microcap space. Then we call different peers, our friends, like we are having today's session, which is an investing Karwa. We also have sessions like guest webinars, where some of our peers come and present on their business ideas or their investing philosophy. So you can see here, over here also 37 lessons have been covered. And you can see here people like Professor Sanjay Bakshi, whom we all look up to in terms of investing. Mr. Vishal Khandelwal, Mr. Abhishek Basu Malik, Mr. Gaurav Sood. You can see Mr. Deepak Sinoy, Mr. Rohit Chauhan, all the known names in the investing fraternity have been to our platform, have helped us immensely by helping our community members learn a lot about investing. And this last one is the most loved section of us, our SmartSync Services team, because our team has worked really hard. Dhruv, Shivam, Harshal, all of them have worked immensely hard by looking at 100 plus small cap companies, and we define small cap between 500 crore to 3000 crore market cap. And we also have a screener on the, you can go to screener and just look for Triple S small cap watch list. So we prepared this watch list 2 years back. It took us a year to cover 100 companies, detailed research notes on these companies. No recommendation here, but you can just click on any company and find the report. So that's pretty much about Mission Smile. And only for people who have joined the webinar today, for them, there is a discount of 20%. And I think Harshal, you can just share the link and the discount code again. I think Sajal sir is back.
Yeah, hi, Ankit. I'm back. Yes.
Yeah, so I'll stop here. I'll stop sharing. So Sajal, you can probably share your screen again, because I shared my screen.
No problem.
Mhm.
Right. Okay. So let's yeah. So lastly, true risk will always be hidden. That's the beauty of a black swan or a gray swan or whatever, right? Whatever color of that swan. Big risks or even small risks, they don't matter, right? It's small. So that's what I say. I mean, and the key characteristic is that if it's a small stress or a small disorder, it will give feedback. The excess energy released from the overreaction will from that setback will lead to innovations, and that's how a business becomes anti-fragile. It doesn't happen by magic. The excess energy release from that stressor or the disruption or the disorder, the overreaction, that is, it liberates extra energy, and that gets channeled into innovating new things, whether it's a process innovation or a supply chain innovation or a product innovation. Right. So we have a case study. So before I jump onto the case study, if you have got any questions from your side, Ankit, now is the opportunity to take them, or if there are any other questions that otherwise when I start getting into the case study, I'll be comfortable in taking questions on each of those case studies as we go.
Sure. So maybe a couple of questions from my side. Okay. The first question which I'm asking, which it is on a lighter note, where I ask you that before I move on to other questions, I wanted to ask you this, that Taleb talks about mediocristan and extremistan, right? And I have read your book, and you chose the word Mudistan instead of mediocristan in your book. Any particular reason for the same?
Right.
So, for the benefit of all, because some of the participants might not be aware of the concept of mediocristan and extremistan. So maybe you can explain that concept also.
Sure. No, I got the question right. It is interesting. Yes. So Taleb is so extremistan is the term that I borrowed from Taleb. And so let's start with mediocristan. So what is a mediocristan? Because that's what Taleb is used. Mediocristan is 9-to-5 job and bank FD. A person that spends 30-40 years doing a 9-to-5 job and investing in bank FD is staying in mediocristan. So low downside, low upside, and both will cancel each other out. So net gain is zero. So mediocre. And India was also in mediocristan, so Hindustan of pre PV Narasimha Rao. So this is in 80s, 70s, 60s, right? So before PV Narasimha Rao started opening the economy along with Dr. Manmohan Singh, India, the Hindustan that is, was in mediocristan, and we used to call it Hindu growth rate. So that term is no longer being used. And the GDP growth was used to be 3-4% sustainably. So it was kind of a mediocristan. So low downside, low swings either way, plus or minus. So that's a mediocre, as the name suggests. Extremistan, we know, and we have discussed that. The reason I have used Mudistan, so that's the something that I kind of coined for this book. I want Mudistan for me is a small stress, a small disruption, volatility which is manageable, volatility which is not significant to kill the business, but volatility which is significant enough to give a feedback, a meaningful feedback, so that the management makes changes. So any kind of disorder which is up to a limit, and that gives a pain which is measurable and a pain which gives a feedback for extra energy overreaction, that is to, and then help the business innovate and make a new high. That's what I called Mudistan, and I've used examples from ISRO, examples from Indian Armed Forces to explain this concept of, because why I say Indian Armed Forces are anti-fragile, because they have been through several Mudistans, wars, internal terrorist attacks, ambush in J&K and elsewhere. So they have many brave hearts have lost life. So that's the kind of Mudistan scenario, if you like. But then Indian Armed Forces is perhaps one of those few who are fighting fit. Because there is always some sort of a disturbance or a small war, either on the China border or on the LOC or wherever. So kind of in the cricket parlance, we are match fit at all then. So that's and ISRO, for example, I mean, they had no resources. It was fragile bureaucracy. It was fragile government, and they were not getting, so rocketry movie, right, the Nambi effect. or Dr. Kalam, right? Abdul Kalam. They they were deprived of all the resources. There was a stress. The moment that stress got lifted, ISRO is making all the right kind of noises, and I'm sure ISRO will do very well, and not just ISRO. I mean the IS, the Indian Institute of Science and Indian Institute of Technologies, they will create innovation like we have never seen in our lives over the next foreseeable future. So that's what my definition of Madistan is: small shocks, overreaction, excess energy, innovation.
Right. Right. So I think before you start the case study, I just have one last question from my side.
Sure.
Then we can maybe after one case study, I can come up with more questions.
Anytime. Feel free to interrupt me anytime.
Yeah. So I think you mentioned it in your book also, and this Peter Thiel was the original person who said this, that all happy companies are different. Each one earns a monopoly by solving a unique problem. All failed companies are the same. They fail to escape competition.
Yeah.
And you took, and in your book, you gave examples of Biocon and Loris Labs to prove your point. I would love to know more about it, and also if you can give some different examples here.
Yeah, let's do a different example.
Yeah.
Because same would be boring, right? Especially
Yeah,
for
yeah.
people who read the book,
Exactly.
like yourself. So let's take Newland as an example. Same promoter, same management, different outcome. Generic, large volume, leverage time, lot of competition. Price. So they failed there, or they're not as successful there because they are not backward integrated like some of the other players. So Divi's as an example, right? But they created something that even Divi's hasn't, which is Austedo as an example, which was the first deuteration molecule, Car XT now. So same promoter, same management, collaboration, winner, competition, loser. Any other?
If you have time, I can ask a few more questions.
Go on then, quickly.
No, or maybe,
It has to be a real good question.
But maybe case study is more important. So you can maybe cover one case study and then I'll come back with my question.
Yeah, sure. So this case study is about, sorry, I can't see and set you free, my baby. She said in a tone of fear and desperation, and we will figure out soon. So fragility meets a disorder. So beautiful business, 30 to 35 billion market cap, net free cash of USD 500 million, annual free cash, and a CRDMO business. In enzymes, all the way to CAR T, precision therapies, and also working in areas where the drugs will be out 10 years out. So imagine a company end to end, from enzymes all the way to anything and everything in the world of new frontiers in science. 35 billion market cap, 500 million USD free cash, and net cash on books. This could have been Biocon had they stayed with this engine model over the last 40 years. But again, obviously, this is wishful thinking. The real Biocon is this, which is so this is classic. So you could take dose as the debt and response as positive or negative. So a small debt is good. It helps you become more tax efficient, but excessive debt kills the business. And we have seen so many examples where excessive debt has caused permanent sort of damage in the and shareholders end up suffering, right? So reasonable debt is WACC positive, weighted average cost of capital, and tax friendly. Excessive debt kills optionality, because if you've got so much debt, you will have to let go certain attractive opportunities because your hands are tied, right? CFO Indranil Sen, after very long tenure with Biocon, recently resigned. I don't know how to read into it. And they have been tinkering. So they have been tinkering, selling a small stake in Syngene and in Biocon Biologics to acquire Viatris and other things. But I think those tinkering small options are pretty much exhausted, pretty much. Biocon's available cash, and I'll explain what I mean by available. There's low free cash generation, the available that is, cannot meaningfully reduce this mountain of debt that they have got. So even if I take their Biocon Biologics, they keep reporting adjusted debt, and 1.2 billion is what they reported, but that's adjusted. It's about 10,000 crores, give or take, debt. The business that is having sales of 10,000 crores. So sales to debt ratio is 1. I'm not talking about debt equity or EBITDA to debt ratio. No, sales is equal to debt. Clearly, that's a mountain of debt they have piled up for whatever reason. It's well documented. And if we assess the fragility of Biocon, we see high debt, which is concentration. So any kind of concentration is bad. So in case of Biocon, it's exceptionally high debt, right? Predictive, they keep giving guidance. So this turkey mindset that I have spoken about in my book. So predictive, selling good assets. So they recently sold their branded generics, which is, I think they sold branded generics previously as well to Eris. So high ROCE business you are selling, low ROCE you are nurturing, low free cash generation. What are their potential options at the moment? Maybe sell further stake at Biocon Biologics. I don't know. Whether Mr. Poonawalla would be interested and what valuation, because the last valuation was 6 billion or approximately. They cannot demerge Syngene, in my view. Demerger of Syngene would be a blue sky. If they could exit their generics business, get free cash, if they could exit Syngene, get cash, then it will be a pure play. It will be a pure play biologics company in across biosimilars and novel innovation with net cash on books. So they will become almost overnight, they will become anti-fragile from fragile. But if they sell Syngene, there will be negative cost synergies because the shared campus and resources, etc., etc. But the bigger problem is, so there's the blue sky scenario, extremely rare event. That's why I'm highlighting it. And the blue sky is completely exit generics, completely exit Syngene, become a net cash, pure play biologics. But that will not happen. That will not happen. And the reason is their credit rating will suffer because Syngene is giving them that assurance on the credit rating, right? So if they get rid of Syngene, the credit rating will tank and it will be a doomsday scenario for Biocon. In my analysis, I reserve the right to be wrong. So positive gray swan for Syngene is equal to negative gray swan for Biocon. This is kind of a liquid oxygen. And so that's where I see Biocon to be. If there are any Biocon specific questions, I tweeted earlier today. I'm happy to take it. Otherwise, I'll move on. Very quick. Ankit?
Yeah, I'm just.
Sure.
Mhm. No, I don't think any question is there related to Biocon.
Yeah. So for those who don't know, new Gen Z and new age investors, Biocon started with enzymes. So that's what their origin from papain. They used to extract enzymes from papaya. Beautiful business. Enzymes is the next big thing, right? And that's why I'm interested in Laurus Bio. That's why I'm interested in advanced enzymes, proper disclosure. So this could have been a 35 billion market cap, pure play CRDMO, a gorilla, a real gorilla over a period of 45 years, which is what the age of this business is. But that's wishful. And here I've explained, what I mean by available. So it's ex-Syngene CFO, because Syngene is not sharing any cash with Biocon. It's just there for the credit rating. And how will PE investors make money? A lot of private equity investors have bought at random valuations, right? Think about their opportunity cost and the magnitude of impact versus probability. I keep saying that, it's the magnitude much more important than the probability and the frequency. I mean, I could be wrong. I was wrong in IPOs for 97 out of 100 times, and I still made money. It's the magnitude and the probability. So what's your probability? Russian roulette. If the price is 1 trillion, and someone tries that and wasn't killed, they make that money. The next person will get excited. So bull market scenario, Russian roulette game, right? Second person tries, they also don't die. They also make a lot of money. The third person is now interested, so on and so forth. And there will be data. The past data is saying that it's a free money. There's data, right? Because you're seeing that it's there in the reported quote unquote earnings that, it's a great call. It's almost a free lunch. You try, it doesn't harm you, and you win a jackpot, you win a lottery. So it's kind of a free money until the point that there will be an obituary, the person who will ultimately pay the price. And that's classic bull case trap, where past data, the rear view mirror will be very rosy, very rosy. A cyclical will look like a Nestle. It will lure you into it, all the sort of hindsight biases. Then it will lock the door and it will kill you.
So, Mr. Sajal, there are suddenly a few questions on Biocon. I'll just jumble
Excellent.
them up and ask one question to you. So, generally, the audience is asking about what is your view on the decision-making capacity of the management over the long term, maybe 20, 25 years, and how do you see the business today from a fresh lens? If anybody looks at a business like Biocon today, what would be you telling them?
So net cash, Biocon Biologics, excellent business with balance sheet almost laden right up till here. You could hardly breathe. And that's almost a ticking time bomb kind of a scenario. That's my honest opinion. I'm invested in Biocon because I will never sell Biocon. I'll tell you why. I want this to be a permanent lesson for me. But my average cost is near zero. It's about 2 rupee or something, even though I added some more last year as a proper disclosure. So at 250 odd, I was a buyer last year. Including that, my average is about give or take 0 or 1 rupee, because I made in hindsight, of course, I was lucky. I sold in 2018 when the valuation was 40 times EV EBITDA, and there was a lot of optimism around biosimilars. I was not comfortable with that valuation because I've got this heuristics: 40 times EV EBITDA, sell, I mean, whole or part. In this case, because it was Biocon, and I had that emotional connect because I've been invested in Biocon since 2004, and I'm still invested. But I always liked Syngene over Biocon. The reason I was interested in Biocon was because there was baby inside mother's womb. And I was hoping, wishful thinking, that it will be a clean demerger like Jubilant Pharmova and Ingravia, where I will get both businesses. That never happened. And they made a lot of promises, and I've got all this in a long sort of pages, well documented in the book. I think page 243, if I'm not mistaken. But yeah, so that's, I mean, I don't know. I can't predict the future. We are all hindsight champions, and I'm also one of those. I cannot predict the future. Biosciences as a business is the most lucrative opportunity, but I would rather play it through better opportunities. I mean, I shouldn't have bought a small additional amount last year. So that's my current understanding. Again, this is a very opinionated thing, but because I've got a skin in the game, I'm still invested, and I'm not selling Biocon. That's for sure, because I want this to be, and my sort of wall of shame, if you like, that I made this mistake. I couldn't read the management. But Syngene is a very different kettle of fish. So Jonathan Hunt is doing a great execution, and I'll give you a very small example. On the balance sheet side, diagonally opposite, they're acquiring businesses. So they paid top dollars for Stellis or Strides biologics asset. After buying that asset, the balance sheet is still net cash. And any business that is giving you a perception that my margins are low and my ROCs are low, but my balance sheet is net cash, is fooling you, is fooling market, is fooling competition, that it's a gruesome business. Don't enter into this business, because we neither make ROC, we neither make margins, but we make a lot of cash. And all that cash is unseen. And they acquire companies and they're still in a net cash. The only business in India that has disclosed a 10-year on stock exchanges commercial agreement. No other company, including Divi's, none of them have been able to do that. So again, same promoter, same management, two very different outcomes. Okay, so let's move on, Ankit, shall we?
Sure, sure.
Okay, so the next case study is don't predict. Your entry valuation should be so low that you don't need to predict anything. And that's so at the top of the pharma sector bull run, 2014-15. That was the peak. I mean, Lupin was 10 times price to book. Ridiculous. And Sana, I think, was also 9-10 times price to book. At that point in time, I saw comfort in the valuations of RPG. So not anti-fragile management, sleepy management, I would say, but the valuations were so low that I need not predict anything. So I did not do any DCF, no forecasting, nothing. I said it's a sustainable business, very good brands that competitors would love to own in RPG life, textbook brands. Management is the only thing which is missing, but I'm getting compensated, or much more than getting compensated, because of these valuations. So my first entry was somewhere around below 100, if I'm not mistaken. Yes, I think 2014, my initial August time. I mean, I don't exactly remember. I don't think there has been any split or bonus in RPG life. So it was below 100. That I remember. And then I've been averaging up. So I think in January 2015, it was 100 or thereabout. But in 2014, it was below that. Same for JB. At the peak of the sector bull run, the valuations, they were expanding. They were hiring MRs. So JB was something very similar to today FDC. They were hiring MRs, but none of them were productive or adding meaningfully. So the margins were optically depressed at a JB level. The only difference between JB and FDC is a much better management, I believe, because they have learned the lesson. So they are investing behind OTC and nutraceuticals and functional foods. US FDA, they cleared sterile in the current environment with zero observations. So I think pretty much a very similar kind of a story where JB was in 2014 or whenever I bought it. And price again I paid 150 approximately for JB, but then I've had one sort of split since. So adjusted for split, I only paid $70 or thereabout in 2014, and see my. So I need not predict the future if my entry is dirt cheap and my business is good, and management is not fraud. So this is not a fraud kind of a management. And likewise for Tata Global 2016, I wasn't predicting. There was a big tussle going on between Cyrus Mistry and Mr. Ratan Tata. So this was November, December, or October 2016. Yeah. So November, yeah, I've got the date. So 11, yeah, November, and yeah. And price was, I still remember 116, 117. There have not been any split. And I did some more average up. But yeah, most of my 80% of my buying was in 2016. So don't predict. That's the thing. And again, that's my recent tweet on Tata Consumer, that, yeah, $116. So know the Madistan or the stop loss or the max downside of the floor. You need not predict the ceiling or the extreme. So management change, that was the jackpot, right? Again, I couldn't have predicted that Mr. D'Souza would start running this company in 2016. TCE grade management. So for those who don't know, TCE, I've explained in the book, is trustworthy, competent, capable, and full of energy. That's what Mr. D'Souza is. First thing he did was he started removing sludge, which was created by previous management. There was a lot of sludge in the Tata Global, or the previous company. All was created by the previous management, and they started creating distribution categories, premiumization, operating leverage has started playing out. The question mark that I have got today is, will ROCE improve? Will they walk the talk? And Mr. D'Souza has promised that ROCE will improve. I don't know if that will happen. I don't know the outcome, but I'll wait for the outcome. I see good brands, good growth, both organic and inorganic. So their strategy is very simple. We have the distribution. We'll keep adding categories on existing line of SKUs, and we'll acquire small acquisitions. Easy to integrate a small acquisition versus a large one, and we'll go into premiumization. So for the same asset base, we'll make more money, more margins, more profit. ROCE will improve. So that's the theory. Time, not the timing. So I wasn't timing Tata Global or Tata Beverages or whatever. And again, repeating the warning that future is unpredictable. None of these case studies are a buy or sell recommendation. And you have to look down. People do the opposite. People start dreaming about 100 baggers from day one. 100 bagger is just an outcome. If you buy low, if it's a good business, good management, over a period of time, 100 bagger, even 200 bagger will happen. But you have to give a reasonable amount of time, 15 years to 30 years, if you want that kind of a large gains. Any question on Tata Consumer very quickly?
So before asking that question, I'll make a disclaimer. So Tata Consumer has been an old stock in our portfolio also since 2019. So since I have tracked the company and hold it in the portfolio, I can ask a few questions from my side itself.
So you are an anti-fragile investor.
No, nothing like that. So our thesis was very simple. We were tracking it since 2016, but 2019 is when N. Chandra took over, I guess, 18 or 19, and he gave a very clear dimension as to what they are going to do, what they are going to focus on, and specifically in 2019, something new happened in the company where, for the first time, we saw Tata Group of companies. They basically sold units at loss, where loss-making units were getting sold. Prior to that, there was nothing happening like that. So if I remember correctly, the name of the, I don't remember the name of the CEO at that time. But if you listen or go to the con calls of 2016, 17, investors used to come on the con call and talk about what kind of, so it was basically a sleeping company since 2000.
Very sleepy, yeah, lot of sludge.
Now, even though the stock price has moved up a fair bit from the COVID lows, and if you can see now, even in terms of price earning ratios, it would be north of, I think, 60, 70. I've not checked recently. Easily 50, 60 times or more. What I want to ask about you is that, see, when now it is not an undiscovered stock. It's also in the Nifty 50. How
Yeah,
do you
yeah.
look at businesses like this, where, of course, there is still a growth potential, a large growth potential, because if you even look at just Tata Starbucks, which has just started, and if you look at what has happened in China, for the first 10 years, they took 10 years to cross 400 or 500 stores, and in the next 10 years, they crossed 3,000 stores. So India has already crossed 400, 500 stores in the last couple of years. So how do you look at these businesses when from time to time the stock from all the valuation metrics will look very expensive? So how do
Sure.
you?
So let's simplify this. Let's assume that Tata Global or Tata Consumer, I keep saying Tata Global, Tata Consumer is at 100 PE. Make it interesting and very expensive. I said in the beginning, and I explained why, world is getting increasingly fragile, believe it or not. And random events will keep happening and accidents will keep happening. The frequency of those accidents and random events will only increase going forward. So in this case, I will hold, but I will not probably add, and I will wait for an accident to happen, like it happened in Newland Labs. Same thing. I cannot predict what type of accident it will be. I cannot predict when it will happen. But because the world is getting increasingly fragile, something or the other will happen. Management change or some random event which I cannot predict. And there may be a disbelief or whatever, stock may correct sharply. I will see what the valuation is at that point in time. So Nestle Maggie incident as an example, fragility, accident, reaction, you step up. That would be my framework for not just Tata Consumer, but for JB or RPG or any business where I'm invested, including Newland. I'm now waiting for an accident to happen.
So you will load up only when there is some accident happening.
That's
What
my
about your
template.
existing
That's my
position?
template. See, I've got 17 or 18 clients, family members and friends, and I keep educating them. And if they don't learn, I say you go to mutual fund or wherever. That's how I will invest your money. And many times in my own family, when you ask them to give money, they will not, because it's in a bearish phase or whatever. The news flow is not positive. So, oh, we have got, that kind of expense coming up. We haven't got money. Suddenly in a bull market, they find all the money. I don't know, magic happens and they will call and they will push me. Give us something, give us something. There's a boom in pharma. I mean, you know everything about pharma. You've written a book, give us something. So I give them one or two names where I'm also buying. But other than that, my framework is very simple. Anti-fragile business, wait for accident.
So just a small follow-up on that. You will wait for accident for putting in more money. But what about your existing allocation, which you have already
I will
done?
not touch it. I will not touch it because of the lesson Balaji Amin's HDFC Bank.
Right.
Your loss is extremistan.
Right.
You
Got it.
sell a good business and in a portfolio of 20-25 anti-fragile assets.
Right.
I've explained this framework in the book Hurricane versus Tornado. So I will play hurricane thesis here. Whenever there is a hurricane and the hurricanes keep coming every year or two, in
Right.
those 20-25 assets, it's highly unlikely, improbable that I will not find 2-3 in that hurricane sort of framework. I've explained that in greater detail. So that would be my strategy.
Right. So I think you have more case studies to cover.
Oh yeah.
So
Many.
yeah,
So
maybe I'll reserve my more questions for later.
always. So again, example of just wrapping it up, the JB and the RPG, and this is my recent tweet. So I've explained what was happening in 2015, and everyone was bullish, institutions, brokers, the research reports, free of charge floating around, you ask for one, you will get two research reports. And this is not about survivorship bias. So I've explained, I bought many assets there, not everyone, Wockhardt included, which I exited, of course, as a disclosure. So this is about not following the herd mentality. So when I tweeted this, there was a response that came because he said, you have got management access. So I clarified that when I bought them in 2014, 15 or whenever, I had no management access. And I think management access could be detrimental. If you don't know, if you don't have the power to judge a management, they will tell you X, Y, and Z, and you will assume X, Y, and Z, and maybe you will extrapolate that. You might assume that management is conservative and they are saying 100 crores, it may actually be 110 crores. Your brain will start hallucinating. So management access may be detrimental for most people. Let me be brutally honest. So if you haven't got management access, read annual report. So there was no earnings call for Newland when I bought Divi's, same example, dirt cheap business. RPG, no earnings call was happening. JB, no earnings call, or maybe JB was doing earnings call, I don't remember. Annual report was my only source of knowledge. You don't need management access. It's good that you don't have management access because you may do some stupid things. And I've seen people doing stupid things because they were misguided. Second case study, counter-cyclical trade by deep pessimism, but return favors during hyper optimism. So buy low, sell high, always invert. If everyone is buying a certain sector, it could be any sector, hot sector, hot stock, just avoid. Keep it in your watch list. Wait for things to turn. No one was interested in rail PSUs. Suddenly everyone got interested in rail PSUs in Jan Feb. That's the kind of counter cyclical. And so I'll give you one example. Again, this disclosure, it's completely unpredictable. So this is an example of Madistan to Extremistan right in front of our eyes in a jiffy. So this is Sangvi movers from less than 40% EBITDA loss making and low rental yields to more than 60% EBITDA today. Extremely attractive rental yields. From no one wants the crane, Madistan scenario a few years back, to now new cranes are shipped directly to customers from the port. So that's the trade from Madistan to Extremistan. From low downside, no need to do any prediction, to everything is hunky-dory. Now the Turkey will start predicting that, can this margin stay at X? Can the margin improve? Because the valuations have gone up. Now you get into that predictive. You are a compulsory Turkey now. You can't help but act like a Turkey, and market will not give you a warning that Thanksgiving is coming. So Turkey was predicting that the humans, mankind, the butcher is taking good care and feeding, and such a lovely, because the hindsight was there. The bird was getting all the data that every day I'm being fed and taken care of, and this is such a beautiful setup. And then Thanksgiving happened. So avoid that. DMCC again. Look at the classic say. Depreciation has gone up 3x. EBITDA is flat to negative. So business has got all the capacities. The validation batches are out. Boron is kind of playing a role in drug discovery and development. Outcome may or may not come because it's unpredictable, but I'm not paying for the future. So I added some more very recently, few days back. And again, my average price in DMCC is somewhere around 100, 125 because I've been invested for a few years already. But I want counter-cyclical trade where I don't have to predict anything. I think if my stop loss or if someone is buying DMCC, they know nothing about the business, put a stop. If you're a very aggressive investor, short-term investor, I cannot recommend you anything. I'm not registered, but this is what I would do. If I'm fresh and I've got no understanding of DMCC, I'll put a stop loss of 225 as an example, or maybe 240, whatever. And if my stop loss is taken out, that's fine, a small loss. But if it doesn't get taken out, then the gains are mine. And again, in those scenarios, if I'm aggressive, I will keep my trailing stop loss. Smart trader. So the circle of competence is not sector agnostic. A smart trader who is aware of, self-aware, and he knows, that person knows what is risk management, they will keep a trailing stop loss if their horizon is short term, and they will keep locking those gains. The problem with trailing stop loss, and you could put that trailing stop loss in Wockhardt or any asset, the problem happens with trailing stop loss is circuit down. If it opens circuit down and it stays circuit down for whatever random event, then you are gone. So barring that kind of extreme event, trailing stop losses usually work. Moving on, drug discovery workflow. So I'll let you read this lengthy text, and then I'll explain the reason I've included this here. This is from Suven Life Sciences. I'm not invested in this stock. So previously, so they've been investing for the last 25 years. And I was in Hyderabad. I met them in person, and we had a very productive, long discussion around many companies who are doing clinical trials, not just Suven. And it's good scuttlebutt, right? And they accepted that the time opportunity cost of capital, or the time value of capital that they have invested, is significantly more than what is there in the annual report, because you could have done X and not Y, right? So you could have invested the same amount of money in an index or a portfolio or whatever of good assets, and that would have compounded much more. The mistake, and such a brutally honest management, they're so candid, they are accepting that the way they were designing those, it's all about design. And most managements will not tell you that they are trying to jump a 1 meter pole. They will say, oh, this pole is very high. No, the way you design a clinical trial is everything. And design is different for different regulators. Some regulators will assume that 40% marks are good enough. Some will say, no, you need 90% or whatever. So the design has to be spot on. Right at the time of, before even filing the IND, when you are initiating clinical trials, you got to engage the regulator in the end market. So US FDA, if your aspiration is to get at least some return. Any company can launch your drug in an ROW or an emerging market. And if your design of the trial was acceptable to the local regulator for whatever reason, because they're desperate to get some drug or whatever, you can do so, but same design will not work in a different or a highly stringent Japan or US kind of a market. But look at the honesty of this management. So I want to partner with a management that has got A grade. So this is, I've taken from beautiful book, Daniel Kahneman, Thinking Fast and Slow. I want A grade resources and capabilities, and I want luck to happen. So any business will have periods of good and bad luck. If your resources are there, so you're just waiting for an opportunity, like you're there in the slip waiting for the cash to come, and sooner or later you will get lucky, right? So that kind of setup I want. And see this, another very ethical management. I'll let you read this, and then I'll explain what's happening. This happens all the time. It will happen in India. It will happen everywhere. But look at the honesty of this management. So this is a rare disease drug, antibody for as a CNS, autoimmune. Blood-brain barrier again is a very notorious thing, and I've explained in the book, I think in appendix A, I think it is. Innovators often attempt to extract some positives even when the trial outcome is unsuccessful. That's what any innovator, Indian or overseas, would do. Always. Rosy picture. Oral insulin has failed, rosy picture. Same for everyone. Roche is doing exactly the reverse. That tells you something about their character, which is so rare in this industry. And this is happening over a period of just a matter of days and this is Roche, and this is in partnership, I think, with Chugai. So from best in disease potential in this disease, right, which is what they said just a few days ago in an investor event. So they were giving all the rosy outlook in a very recent investor event, and suddenly the Thanksgiving happened as far as that experiment is concerned, and they say did not reach our expectations. And all this is happening from Extremistan to Madhistan at that experiment level in a matter of few days. And so this is just yesterday's news, by the way. I have seen drugs fail even after a promising phase 3 readouts. Let alone in this case where the readout was not promising. So readout was very promising, or that's what management portrayed. The filing was done, US FDA rejects it. After 15 years of R&D and so much money, and after investors were kind of fooled by randomness, US FDA rejects the application. Another scenario is the drug was successfully launched, but then the trials were designed in such a manner that the side effects, iatrogenics, that the benefits were visible and near term, the side effects were hidden. The side effects started emerging as soon as the drug was launched and the wider population started consuming it. And then you get into this legal litigation. And operators would sell much before a retail investor. And the turkeys or the suckers will be left holding. And this happens all the time. All the time. And this will happen again and again because people will not change. No matter how much I tweet or how much sessions I do, people will not listen. So again, this is let's take Wockhardt as an example. And someone pointed out a long note on value picker done by Sanjay Kumar. So he's an iThought analyst, a great guy. So I know Sanjay very well because he used to DM me and he was in early stage of understanding the sector. So this was 2019, 2020, recent last few years. Very energetic, very passionate guy who is committed to do hard work. So from that perspective, I think I thought guys are lucky to have Sanjay in their team, but he is learning. He's still a rookie, and I consider myself as a rookie as well, because in 0 to 1, read that Peter Thiel book. Where is it? Here. This book. Read it, and I've read it so many times, and I've got the areas marked. It's a beautiful, beautiful book. Or Fooled by Randomness, Nassim Taleb. So Sanjay is very hardworking. He's doing all this. So he's got a lodge. You should read that on Value Picker. And this was following one of my sessions with Aditya recently, and he's got all the data. So Turkey had all the data as well. And in the previous example, Roche, the management had all the data. In the investor, this one, so management had all the data. They were promising that everything is fine. Within a matter of days, Thanksgiving happened. you don't know what you don't know. That is the nature of this industry, unfortunately. Bad things, shit happens. It will happen again. I'm not trying to scare anyone. I wish people make a lot of money, but keep your stop losses. Don't be fooled by randomness like Roche has been. But how many managements are there of the quality of Roche? So Roche is saying, I don't want to do business with China. I'm getting a lot of pressure. I want to get out of. How many managements will openly say that? A lot of I've private conversation, a lot of them will say, we want to move supply chains. We are getting a lot of board level pressure, but they may not say that openly because it may not be well received by the incumbent, i.e. China in this case. But Roche is a very different kind of a management, brutally honest. Not every management will say that. So if you're invested in Wockhardt, make sure that you understand that our 20-25 year period has got an opportunity cost of, so 1 is equal to 5 adjusted cost of, that's the real cost of drug discovery. Design is different depending upon which market or which regulator. So what works in India may not work in US, as an example. And you need to have net margin of safety is a combination of management, business, and valuation. So you need to have all three, and here's a adjusted time payoff and probability of. I don't want to play a game where my probability of failure is Roche like. In late phase 3, I get disrupted or get bad news. I'm not capable enough to read into clinical trials better than Roche. I accept that. I'm not good. I'm a rookie, but I'm happy to be a rookie because then I'm petrified. I will keep a very large margin of safety, and I feel comfortable that way. That low probability of failure, 20% long-term compounding. Something like Syngene since IPO has been compounding 20-21%. It may compound at 18% in future. It may compound at 15%. I don't know, but I don't want to take any sort of unnecessary Russian roulette type of risk. Any question before we?
Sure. So I'll just ask one question from my side. So shall we take the Twitter questions now, if you are fine?
I mean, yeah. I think we can take it.
Yeah. So there were a few Twitter questions which we found very attractive and interesting for today's discussion. So somebody asked, what do you think about infra when you talk about fragility?
Yeah. So I think I explained that is CDMO fragmented. It's a fragile industry. Many players will die in CDMO or get acquired, and not everyone will be able to scale up like what Newland, Laurus, or Syngene have done, or Divi's has done. Out of let's say, including startups in India and the unlisted space, give or take, there are about 100 plus CDMOs on the innovator, including generic. There would be 1,000. And very few will be successful, like that sperm example, right? Only one winner. So on that basis, I think, what was the question again? Can you remind me?
The question was like, can infra move from fragile to
yeah. So again, infra is like, so how many Sangvi movers do you see today? How many L&Ts? How many paint companies are there in India today? Large size paint companies. A lot. How many L&Ts? Why? Think why. How many small infra companies will be there? Too many. Because the barrier is low there. Same industry. Construction, building material, infra, same industry, one L&T, too many chotu and small micro players. So very sort of fragile environment, most will die. And that's good, because if the components are fragile, the overall industry structure is anti-fragile. So industry structure is anti-fragile. because businesses will keep dying and competing each other, like those sperms that all of them died competing in the race. But that's exactly the kind of setup that consumers want. That's exactly the kind of setup that a good progressive government would want. So many microfinance companies, many consumer durable companies, many infrastructure companies, many pharmaceutical companies, let them die or be acquired. And so that gives you a very sort of robust, if not anti-fragile industry structure. Too many hospitals. There should be, 1 million hospitals in India. That's great. That's what country wants. Most of them will go bankrupt because that's what makes the component level, that's what is introducing the component level fragility, and very few will become successful over long period of time. Same for infra.
Right. So, in one of the Twitter posts, we had confirmed that we'll discuss on Nitta gelatin. So, if you would want to,
Counter cyclical.
okay,
So replace Nitta gelatin with Sangvi movers.
okay,
Everything is the same.
right,
Buy it below the long-term mean, good product, demand, but you cannot predict demand.
right,
So margin of safety.
right.
I'm invested as a disclosure, but again, I think it's played just like the Sangvi movers counter cyclical trade.
Got it. And your views on banking and financial services from the lens of
We
regulator?
covered microfinance. Same. Ideally, I want India to be having a lot of microfinance companies, a lot of them. And then the good ones they keep acquiring, the good ones likes of Kotak as an example. Again, no recommendation. But consumers will get a very good bargain. So 2, 3 Geo Finance type of large, Poonawalla and Geo, 2 or 3, and then lot of small micro caps that keep, just like restaurant business, na? They will keep closing. So new restaurants come, old one go bankrupt, but consumers get a great taste and great pricing, great bargain. Exactly the same setup should be for the banking industry. It's a fragile business because it's levered 10:1 or whatever. But that's the nature of the business. I've been waiting to find a debt-free bank. I haven't found one.
So I have one more question related to Twitter question, but I found a very interesting question on the chat now. So I thought I'll ask that first. What's your view on healthcare sector focused mutual funds?
Again, it depends. I think I answered someone very recently. You pick any random. So fooled by randomness, pick randomly, abracadabra. You pick one. Top 3, 4 holdings will be common because they want liquidity. I mean, fund manager has got their hands tied because they don't know when US FDA will kiss one of their investee companies and they would have to exit. So they are looking for liquidity. It's not their fault. Even if they know that RPG Life Science or JB is a good business, A, because of valuations, maybe JB or RPG because of liquidity, they will not be in a position because you cannot deploy 300, 400 crores in a single asset. With Sun Pharma, you can. So all have got the same holding. I would say look at their holdings, bottom half. If you find branded generics or good quality CDMO players, hospitals which are small and mid, it kind of giving you a feedback or a signal what kind of fund manager that person is. So maybe use that as a criteria, but otherwise their top 3, 4, 5 holdings will be very similar.
Right. So what about, I think you partly answered this question, but I still go ahead and ask you this question. What about what is the best time? This is again a Twitter question, which was asked, one of our Twitter followers who asked this, is that what is the best time to enter a deep cyclical business, considering how low price, low demand, high supply can remain for several years? So ratios again will not indicate when to enter?
No, I got the question. So cyclical will never have, sorry, this 0 to 1. So let's put that aside. The best time or the best strategy in my view to play cyclical would be take a hypothetical scenario where the entire industry as a whole. So if take cement as an example or take paper as an example or whatever cyclical you like, the whole industry is reporting very low ROE. All of them. That kind of a setup that everyone is losing money or very low. So their ROE is near say 8%, 9%, very close to cost of capital. And few will start bleeding or most will start bleeding. One or two will be having a respectable balance sheet even at the bottom. So I'll give you an example of Nosil. Again, I've invested there. Hyper cyclical. At the bottom of the cycle, the balance sheet was debt free. At the top of the cycle, last cycle, that is, the balance sheet was debt free or net cash. So when the whole industry is suffering, you pick the leader. When the whole industry is not suffering, so APIs also is a cyclical business. Why Newland versus others? Because the whole industry is doing reasonably okay. This is a kind of a tornado scenario where the ROE is optically low and it's kind of fooling you. But you understand this business, whatever sector, cement, paper, textile, whatever, you know that ROE is fooling you. And then you play counter cyclical always. There is no EPS because they've been reporting losses. So the sellers are out. If the business is not performing, the sellers haven't got time. It's get rich quick. So sellers will be out. As soon as the sellers are out, there is no incremental selling pressure. You step up and buy. Right?
So we are done with the Twitter questions. Can I squeeze in one more question from my side or?
Sure, please.
Okay. So for this question, again, I'll go back to your book, where we had in one of the chapter, which is 50 Shades of Common Sense and Variability of Knowledge. Just give me a second.
Yeah. I think I've got the book here.
Just a second.
Yeah. I'm opening that chapter as well.
Yeah. So in that chapter.
Chapter 9, is it?
Yes.
Yeah. Uh-huh.
So in that chapter, while you mentioned 50 shades of common sense, so we can't cover all 50 of them. But I think if you can just deep dive on a couple of them with some examples, if possible, I think that would be very relevant today.
I think we have covered a lot of them already. So tornado and hurricane examples. If you have got a validated portfolio of 20 stocks in current market, let's say we are March 22nd, you have got a portfolio of 20-25 stocks, validated, you understand them well. Suddenly there is a correction, which is the hurricane scenario I've explained in that chapter. And some of those will be back to your attractive price point. You step up and add more if you've got cash. That's one. TCE framework I've explained from that chapter. Management is 99%. No matter what else you do, so it's an exam with 2 question paper, 1 mark question paper and 99 mark question paper. No matter what you do in that 1 mark, if you failed in that 99 mark one, the higher weightage one, you're gone. So focus on management and management and management. Everything else will be fine. So that's the framework. Exactly this. Yes. So this is from chapter 9, net margin of safety. So again, example, I've given plenty of examples. Any of these businesses from Narayana to Newland to whatever, Syngene, you name it, my disclosed holdings. Whenever there is a hurricane, If I've got cash, I'll step up. And that's exactly what I've explained in chapter 9.
Thanks so much, Mr. Sajal. So I think now you can go back to your presentation and
Sure.
we'll come up with more questions.
Yeah. So next case study is on, so I've explained this Johari window in one chapter 8, I think. I will let you read this. It's a very busy sort of slide, but it's very important. So please take your time and then we'll continue.
Or if you want, I can read it out for everyone.
Yeah, please feel free, Ankit.
So in medicine today, uncertainty is generally suppressed and ignored, consciously and subconsciously. Its suppression makes intuitive sense. Being uncertain instills a sense of vulnerability in us, a sense of fear about what lies ahead. It is unsettling and makes us crave black and white zones to escape this grayscale space. Our protocols and checklists emphasize the black and white aspects of medicine. Doctors often fear that by expressing uncertainty, they will project ignorance to patients and colleagues. So they internalize and mask it. We are still strongly influenced by a rationalist tradition that seeks to provide a world of apparent security. Yet the reality is that doctors continually have to make decisions on the basis of imperfect data and limited knowledge, which leads to diagnostic uncertainty coupled with the uncertainty that arises from unpredictable patient responses to treatment and from healthcare outcomes that are far from binary. Key elements for survival in the medical profession would seem intuitively to be a tolerance for uncertainty and a curiosity about the unknown. Have we created a culture that ignores and denies that requirement? Could our intolerance of uncertainty, in turn, be contributing to the accelerating rates of burnout and the rising cost of healthcare? For there is no doubt that absolute truth and certainty are hard to come by in clinical medicine.
Yeah. So the orange or the amber highlighted text, make decisions on the basis of imperfect data and limited knowledge. Unknown is chapter 2, friends and relatives of uncertainty. And if I swap, so this is a doctor and patient. There's a concept or thing in medicine, healthcare. Any doctors on this will definitely understand and acknowledge. SDM, shared decision making. So doctor will give options to the patient that, look, given that you have got this, I'm sorry to disclose this, you have got these 3 or 4 options, and none of them is a certain option. Each of these questions have got a probabilistic sort of an outcome. And if a doctor says there is a 90% probability that you will survive this treatment, so that's one messaging. The same doctor, same disease, different patient may frame it differently and say, instead of saying 90% probability of success, they may say there's a 10% chance that you will die and you will not live, or you will not be able to survive this critical operation. Which of these two you think is a same thing? 90% probability of success is same as 10% probability of Madistan. Depending on how the doctor is framing that may encourage the patient to make a certain decision. So doctors are trained to frame the uncertainty and give whatever options are there on the table. The reason I've included this is not because I want to explain this to you. The reason I've included is replace doctor with management and patient with shareholders. And now imagine the equation playing out. What kind of management we expect? We kind of expect the management of the doctor, which is not painting any rosy picture, which is realistic, open, honest. We may be lumpy quarter on quarter, we may be lumpy year over year, and there is uncertainty and whatnot. So you under promise and you over deliver. So the doctor should be preparing that patient mentally. Likewise, the management should be preparing the shareholders. Expectations investing, Michael Mobassin. So that's the reason I've included this. And the reason I've included this is because of my tweet that I did. So this is a year ago. This is on Loris Labs, my 4-engine analogy. And there's a long, very long tweet. I'm showing you the top and the bottom. Important thing is the summary next three. So this I said in March last year, 6th of March 2023. I said next 3-4 quarters will be soft due to X, Y, and Z. Who knows? Future is unpredictable. There are US FDA issues, blah, 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 whatever. And then I've disclosed that, I invested in Loris Labs in 2019. I'm biased on this whole fragility, anti-fragility, CDMO, whatever you may wish to call it. So the role of the management should not be over-promising or issuing guidance. Management should be saying, just like Newland Labs, no guidance, very conservative, and then outperform. So in the anti-fragile case, the business will hide the qualities, but not the defect. And what are the defects? US FDA, that's a defect. In pharmaceutical, pricing pressure, that's a defect. So a sensible management will keep your expectations grounded and they will hide the qualities. And then 16 crore PAT will go to 300 crore. That's what I like. Fooled by random swings. So again, this is Loris. There's too many moving parts, but the reason is fooled by random swings is, if you know, so I tweeted this, Kapil Dev and Wasim Akram. Kapil Dev in particular had a very disguised late out swinger, almost unplayable at times. So, and I've seen a shift in their behavior. The shift is in their recent communication, they are saying our current asset turn is 0.9 and our historic average is 1.1. Our historic peak was 1.4, which was this. And they are doing it for a reason. They are setting the expectation. If the late swing, again, this is an opinionated, so this is chapter 8 and 9 in the book. And I've kind of created this on the back of those two chapters. The late swing, because every investor has got Newton's first law, inertia. How many people predicted, including fund managers, the best industry minds, that Newland will suddenly go from 15% to 24% EBITDA, right? And if you read my note from 16th of September 2022, with all the disclaimer and disclosures, I said something, right? So in late swing, suddenly you are in that inertia that the train has started running, but you are still on the platform. So, and the reason is that 0.9, which is where the current are, which is this Madistan, their average was 1.1 asset turn and the peak was 1.4. look at the chemistry. It was ARV dominated pretty much, at least in somewhere here, simpler molecules. A simple molecule in the same reactor, same fungible reactor will give you only so much. So Newland has got an asset turn, top of my head, of close to 3. Glenmark Life has got asset turn well over 2, 2.5 in brownfield, maybe 2 in greenfield, or maybe 1.75. There is absolutely no reason why, with 1,000 people in R&D, management is paying them salary. So when I went to Hyderabad, I met Newland Labs as well. Their head of R&D, who was leaving. So the news, I think, came out that very day. So that person knew that he's going. He greeted me. We had a nice cup of tea together, and he kind of gave me a tour of all their labs, their peptide lab and other labs of Newland Labs. And then we were chatting, and again, this kind of scuttlebutt or whatever. I said, what do you think about Lotus Labs? So he said, we don't find too many CVs coming from Lotus Labs. Would like to recruit, but I don't find CVs. And Dr. Satya protects their staff. That tells you something about the culture and the pull that Dr. Satya has got. And I spent good 2.5 hours with him and CFO face to face in their boardroom. I was mighty impressed by their honesty. There was no attempt to oversell or overpromise. They were not selling me anything. It was very open, candid. I gave them a lot of negative feedback. They embraced that with all the humility. That's the kind of management I want to interact with. I sent several emails to Biocon and never got any response. So if management is not willing or prepared to listen to a long-term shareholder versus this Dr. Satya or Newland Labs, that tells you everything. So coming back, if you see the moving levers are, there is a level of backward integration. So why do you do backward integration? There are only 3 reasons. There is no other reason you do backward integration. 1, cost. You want low cost. Second is supply security. Third is quality. Only 3 reasons. 1, 2, or 3 are true. You have got incentive. Industry works on, management acts on incentive. There's an incentive to backward integrate. So you're not getting the quality you want, you're not getting the price you want, you're not getting supply security, China or whatever. If you are getting everything, you're getting the quality, supply security, India-based supplier, and the quality and the price and everything there is no incentive to waste capital or deploy capital in one-time asset turn. That's what a commodity will give you. You could use the same capital to get 4 times asset turn in a 30-step, 20-step complex chemistry molecule. You may not get 3 times asset turn in greenfield, but when you do brownfield, because you're not building the warehouse, you're not building overhead electric transmission, you're not building the waste recycle and all the rest of it. So when in a greenfield facility, there are 2 types of capex: the revenue generating capex and non-revenue generating capex. In brownfield, as long as you have created that capacity, and any intelligent management will create that capacity so that the brownfield is a free option or a low cost option, the asset turn that you will get on that incremental capital will be magically better. And then add bottleneck. So I've explained all this in various lenses on chapter 8 and 9. So my back of the envelope is that superior quality peak, the next one, will be significantly better than his, because there are players in the Indian space, complex chemistry. Again, so at a smaller scale, you may get a much higher asset turn. So Newland is getting 3x. At a large volume, even if the chemistry is complex, you may get 2x. But you will not get 1.1 that they're talking about, a 1.4, which is previous peak, because the product mix has changed or is changing. There's a lot more innovator synthesis coming up. Even their formulations business, because see, last 2 quarters, their CDMO is dead. Even then, the gross margins are high. So that's what I've explained in detail. Having said that, I'm invested. As I said, what's missing? Execution is missing. The evidence of execution is missing. Overpromise, guidance, 1 billion, whatever, that was a fragile behavior. To now, if you read Q3 call and my own experience when I went there, under promise. So I extracted a few things which I will not be sharing because we are recording this session. If you speak to me in private, I'm more than happy to share. I had to work really hard to get the data, and I've got the data, but this is not the platform to put any sort of projection, because I may be a turkey myself here and I'll not do that. So, but I see in the Q3 transcript, if you read, people are repeatedly asking, analysts are repeatedly asking guidance. Then they're saying, no, we're not giving guidance. We made that mistake once, only once. I think that Ravi Kumar said that, the CFO, that we guided once. We're not guiding anything. So the fragility maybe, again, we don't know. We would have to wait few years out to figure out whether that overpromise behavior is now changing. And that is about 2,000 crore, which is nowhere near one-time sale, like in case of Biocon. So people keep asking me this, are you worried about? In a steady state, given the capex that they have committed, the operating cash should be 1,500 to 2,000 crore. That may come in FY26, that may come in FY27, that may come later. I don't know. I'm not predicting. But that is not significant in relation to the asset and the commitment that they have secured. And bio is an optionality, big optionality in enzymes and CAR T therapies, IIT Kanpur and all this. So that is all optional. That's all good news. I'm not interested in that. I'm interested in here and now the bad news. So I expect them to start reducing debt in FY26, FY27 onwards. But then with earnings and everything, it's like 16 crore PAT of Newland becoming 300. I'm not suggesting that, because Laurus is at a different scale, it will never happen. But pessimism slowly transforming into optimism as management starts walking the talk. If there is any question on this, I'm happy to take. Otherwise, I'll move on.
So, Sajalji, before coming to the question, I just wanted to remind you it's 9:02, and at the start you told me that you have a stop at.
Yeah, no. So I can stay for some more time if the questions are high quality. Otherwise, I think yeah. So let me.
First, you can complete the presentation. And
presentation is done. So this is the last slide. I'm done.
Okay, great.
So I'll quickly explain what this is all about. So there's a lot of uncertainty, as we have seen. The only antidote is you have sustainable operating cash flow, not like this QIP thing that Wockhardt announced. I mean, if you look at the size of the QIP versus what the operating cash they have generated over a period of last 2-3 years, tells you. So you need sustainable operating cash flow, margin of safety, multiple optionality. As an investor, you need 20-25 stocks minimum. If you are only playing in small caps, have 30-40 stocks, because many would go burst, or that should not, at a portfolio level, that should not harm you. So idea is not to be the turkey, not to be harmed by random events. And bricolage is whatever information you have, you start. It's a French term. Taleb has explained that in the book. And fate sur mesure is made to measure. So your strategy, know yourself first. KYS is more than KYC, know your company, right? Your approach of investing should be made to measure, fit sur mesure. And same for companies. Competitive advantage should be based on your own resources and capabilities so that competitors will struggle to copy you. And you keep learning the lesson, keep pivoting, transilience, transforming while staying resilient, and you aim towards this North Star. So you will never become certified anti-fragility. There is no body that will certify you like US FDA does, 0483. No, that's your direction, not a destination. It's just a direction to go from 0 to 1. Very few will make this journey, very few. So that's it. I think we have completed.
Yeah, so thank you so much, Mr. Sajal. So I think you briefly mentioned about KYS, know yourself, right? And that is a very intriguing point because I remember I happened to read that in your book as well. And where you mentioned that before we look outside like business management industry tailwinds, you must
Yeah.
look inside, right? Inside or as you have rightly coined it, KYS or know yourself.
Yeah.
If I remember correctly, you mentioned about 5 questions we should ask ourselves, and I think these are all sector agnostic questions. It is more of a general investing related thing. So it would be great if you can share those questions here. I think that would be a good way to come to the last segment of the session.
Sure. I mean, I would have to, if you have the questions, I mean, you can, I don't know what those questions, I've definitely 5 points.
It's there in the chapter of valuation frame. Smell the odorless and see the unseen. It's in
Okay.
that chapter.
Yeah, it's definitely there. Yeah, I found it.
Yeah.
So what kind of individual I am, right? That's one. So what kind of individual am I? What are my life objectives? What are my financial objectives? Are they in sync? Third, how do I react in good and terrible times? Do I later regret my decisions or not? Why or why not? And do I grasp the value and value the uncertainty and probabilities in a game which is frequently misinterpreted as 0 or 1? So it's neither pure luck nor pure skill. You have to have a large margin of safety, which is like a door that you are creating. And if you have got a large margin of safety, buying when no one wants to buy or ahead of the growth, you will invariably turn lucky at some point. Again, you cannot time that, I'll be lucky next month or next year. But as long as you have got a reasonable 3 to 5 year of horizon and the industry is not deeply cyclical. See, every industry is cyclical. Every industry is cyclical, including FMCG. But there's a difference. There's a shallow cyclicality and there is deep cyclicality. As long as you are positioned in shallow cyclicality, consumers, pharmaceuticals, hospitals, that kind of, if you buy low with a margin of safety, 3 to 5 years is a reasonable horizon to expect good returns. I mean, even today, my first transaction in Laurus is 50%. 65 or 67 is what I paid in December 2019. As on today, I'm 50%. So you buy ahead of the growth. That's when you get value, but value will remain value forever if the growth is not coming. So you better know at a reasonable level, probabilistically adjusted, that the growth will come, and that's how you position. But you have to understand, you do a job, you do have a salary, your monthly bills are taken care of. You're not a fire. So there's a lot of fire going on. If you're a fire in a bull market, go fire in a bear market. And that too after 1 year of bear market. If your cash flows are such that you can sustain your lifestyle at the bottom of the bear market. See, there are only 3 types of cycles. There's a business cycle, there's a market cycle, and there's the economic cycle. And the order of priority is in that order. Business cycle first. Buy at the bottom of the business cycle when no one wants that asset. Do not buy at the top of the cycle, no matter what the narrative. Don't care. Bottom of the cycle, business cycle, bottom of the business cycle. Newland, bottom of the business cycle 22 or early 23. Not many were interested. Laurus, again, my disclosure disclaimer, right? I'm biased and so, but so always bottom of the cycle And that's the most important. Business cycle bottom. Market cycle doesn't. So 2015 pharma, top of the sector bull run. That wasn't the market was not down. Market as in the pharmaceutical market. Market was at the peak. I bought RPG and JB because they were at the bottom of their business cycle. They were not performing. What is the outcome? Lupin hasn't made that high again, 2015 one. But I'm 30 bagger in JB and whatever that number is for RPG. Even FDC, which hasn't performed as well, at least I'm better off than a Lupin or whatever. But a fund manager could have never done that because of that liquidity constraint, right? So know what your cash flow situation is. Be counter cyclical in your mindset always. Be frugal. Be frugal. And understand your sources of cash flow. Understand your sources of cash outflow. Do you have children? Is there education coming up? Do not bet your house. Secure the future of your children first. Secure the future of your family first. Then do speculation or whatever. Doesn't matter. A lot of people assume that the bull market is here to stay and it's permanent. No one knows anything. Samir Arora, he keeps saying the same thing. Sanjoy Bhattacharya, if you are a Gen Z investor, go on YouTube, type Sanjoy Bhattacharya and just listen to that wise old man. He is the Charlie Munger of India, hand on heart, guaranteed. He saw CDMO CRAMS opportunity ahead of any fund manager. 2014. I've got the evidence. I've got the video. If you challenge me, I'll show you. That guy, Sanjoy Bhattacharya, Ramesh Damani, PSU bull, permanent, PSU down cycle. He was not a current PSU bull. Those guys, counter cyclical. RK Damani, there are plenty of examples. Late Rakesh Jhunjhunwala, same, all of them. When he bought Escorts, 2012, 13, 14, Escorts was a dirty. So again, hospital to it. If you want to buy a dirty business, make sure the valuations are dirty. So follow Sanjoy Bhattacharya, follow those kind of Kenneth Andrade, Howard Marks, S. Naren, those kind of people. Keep listening to their, whatever you are doing, even if you're cooking, let that YouTube video be running in the background. Create that environment around you so that you don't get into speculative like I was in 90s, investing randomly in random assets at random valuation, news-based, free tip, so on and so forth. As long as you don't do that, my objective is not to make you rich. My objective is to not help you, at least to not get bankrupt or poor. That's my objective. If you protect your downside, upside is wide open, unlimited. That's all.
Thank you so much, Mr. Sajal. So I have just one last question. You have partly answered that question already, but I'll still add one more flavor to that question to make you speak on that topic before we end the session. So for investors who have joined the market, like you mentioned about the Gen Zs, so investors who have joined the market in the last 2-3 years, or who will join the market now, or maybe in the coming years, because this video is getting recorded and many will watch this video maybe 2 years from now also. So what is your advice to them? How can they evolve from fragile to robust to maybe, who knows, anti-fragile eventually? So what would be your advice?
So if I go back to my own 90s with all the wisdom that I have today, this is what I will do. I will invest my own money, many optionalities, small investments. So I will have my framework. I'll do my research, simple framework. I will follow the people that I mentioned, that you follow Sanjoy Bhattacharya, Kenneth Andrade, all those good guys. But you can only learn so much by reading a book or listening to someone. Trust me, you have to fall 1 or 2 times. But and you should get hurt, because you have to get small stressors that will kill your ego, that will kill your overconfidence, liberate energy. That energy will help you innovate in fine tuning your process, rewiring your brain, and then becoming a more mature investor. So if you create a portfolio of 30 stocks by following a good process, good framework, outcome may or may not be in your favor. But if you have got a 5-year horizon, even in this market, if you follow a framework and do nothing for the next 5-7 years, your is asymmetry. Your upside will be good enough and have some sort of, if you can't see a stock going zero, because that's the floor, right? You can have a 50% stop loss if it's a volatile asset, or a 30% stop loss, whatever, and ride your winners with a trailing stop loss if you're a very aggressive investor, and you can't help but make money. That's how you will get multi-baggers, 100, 200 baggers over a period of time, but 100 bagger will not come. So research in motion, BlackBerry, 50 bagger in 5 years, and then, and not the only example, Apple versus IBM, halo effect. In 80s and 90s, and even in early 2000, IBM was the big blue and Apple was nowhere, right? What happened? So kill that halo, kill that ego, kill that overconfidence, stay grounded, hungry for learning, and you will be surprised with the compounding over decades. India is the market, promoter-owned, family-owned businesses. It's like Japan. There are infrastructure companies in Japan, or there were infrastructure companies in Japan that were 100, 200, 300. One company was building Buddhist temples. What's the name? Congo Gumi. Congo Gumi survived for 1500, 1400 odd years. Family owned. So they kept on passing the asset generation after generation. I think 30 or 40 generations that asset changed hands. So India is a lot like Japan. And I hope this turns out true. I see a lot of common characteristics between India and Japan: family-owned businesses, conservative management, frugal management, and not spending willy-nilly, economy doing well, currency will start appreciating, and people will start selling exporters, just like they happened in Japan. But the Japanese exporters did very well even during the phase when their currency was appreciating, because they keep innovating. That's what I was lucky to have a conversation with Dr. Raoji, and even Orchid, and same all of them gives the same message, that operational efficiency alone, they generate 3, 4, 5% EBITDA. So India is blessed. It's a gold mine, but it's a gold mine for non-speculators. Conservative people, sensible, and they will get handsomely rewarded. The compounding and the upside will surprise many, but not next year or the year after. You have to have a long horizon, and do meditation, keep your mind calm. Some sort of an exercise is a must have, and sleep well, stay healthy, and outperform. That's all.
Thank you so much, Mr. Sajal, for spending, I think, exactly 200 minutes with us. And it was a session full of lots of anecdotes and wisdom which you have gained over several years now. And thank you so much for the audience who have joined us in large number and stayed patient. I'm sorry we couldn't take up all the questions, but we tried to take all the relevant one as per today's session. And we just want to tell you that, of course, we'll put the recording of this session very soon. Plus, just like this session, we have had many other sessions, which is free for all. I've shared the link of that on our chat box. You can have a look at all the session. Thank you so much, Sajal sir, once again. And thank you so much, everyone who joined us today for this wonderful event. Thank you.
Thank you, everyone. Thank you. Wonderful questions. I really enjoyed it. Bye-bye.
Thank you. Bye.